All right, we're letting a few more come inside. Hello, everybody. Thank you for joining us for the September 21st, 2022 live strategy series from Traders Exclusive. I'm Sherry. I'm your host for today. Today, we're going to bring in 4 expert traders, and I pull one piece of their presentation bullets to present to you that we're going to learn the process of thematic investing, a powerful strategy for trading and working from home, why you should only be buying stocks near their highs, and how to make trading easier to understand and more profitable. And that is the tip of our iceberg for today. Like it if you would please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips. And you know what comes next. We've got to do our disclaimer. So you know, trading is not for everyone. Oh, just a second. Something happened here. Okay, here we are. We're back where I need to be. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations, especially here and anywhere, are subject to change at any time, and past performance is not necessarily indicative of future results. Please take notes and write your questions down with a little bit of context, and hold your questions till the end of the presentation. And also, I want to assure you right now, we are recording this. You can see a replay of it. So if you know anyone who didn't register because they weren't going to be able to attend, tell them to get registered and they will get a replay. So, and without further ado, I'm going to present to you our first expert trader, Greg Schnell of Osprey Strategic. He's going to be talking to us about hunting for the next theme of winners. Greg Schnell, CMT, is the Chief Technical Strategist at ospreystrategic.org, specializing in intermarket and commodities analysis. Greg's work has been regularly read on stockcharts.com platform. I'm sorry, I think something might have been wrong with that sentence. He's going to fix it for me when he gets on here. Hedge funds, RIAs, portfolio managers, technicians, and private investors consider the charts Greg displays from a lot of different platforms. The commentary is valued for being timely, in-depth, unique analysis that generates a valued perspective. Greg has won multiple awards as the top independent analyst of the year in Canada. Greg, welcome. I am going to do my little housekeeping here. Please forgive the botchedness of my bio for you. Let's see. There you are. I'm going to make you the presenter. And you should be able to speak to us and show us your screen. I see your screen.
Okay, great. And hopefully you can hear me, and there should be a camera coming up. So that's good. Let me get over to this. What I wanted to talk about today was we are in a period where the market really does a good job of transitioning from hot sector to hot sector. And as it moves around, one of the biggest issues we've got is for buy and hold investors. They're literally being trapped in what was working yesterday and continues to drift apart. And we had some really good examples of that in 2021, where 2020 we came off the COVID lows and we had lots of price action in, I'll call it the Cathie Woods file, where a lot of those speculative names literally blossomed and took off. And we had stocks like Zoom and Peloton really accelerate. And I think for those that followed not Mad Money, but Fast Money, you'll have, Zoom was rolling over at the top, and some of the Fast Money people were saying, well, people are still going to continue to use Zoom, so I still want to own the stock. And in the meantime, I think we all know what the shape of the stock did. But as the stock pulled back, it continued to trap people in. And one of the big issues we had with that situation was the belief that Zoom would still be needed was true, but the market pays for growth. And so the problem was they had their growth and then their growth flattened out. And as their growth flattened out, then investors sold the stock. We're sitting in a market that continuously looks for what the next growth sector is or growth stock is. And obviously the Investors Business Daily methodology of hunting down those types of companies has become, pretty much market legend. So what I wanted to cover off today was the fact that as the market rotates, each one of these market peaks will probably generate some sort of trend change in behavior. And what you need to be aware of is your theme starting to lose its edge, and if so, how to notice that. And one of the bigger goals for me is to try and stay in the idea of theme investing, but try not to be so narrow as to stay in just, as an example, if Tesla is doing well, then how do we invest around Tesla? Well, maybe it's either the electric vehicle, and we saw how that all ended up in February of 2021, and then it was the move to green. That was the material stocks like copper topping out in May of 2021. And so we see the market move through these cycles, but at each one of the market crests, we start to lose different themes that we're working and move on to the next one. So what I wanted to cover off today was just kind of a general market overview where I think things are, because I still think we have a problem trying to go forward. And then at the end, I want to cover off this theme concept, and I've loaded up my tab here called the energy crisis. And I'll talk specifically about that. Now, there's really two phases of the energy crisis that I want to talk about. One is the move to green and what's required to do that. And then the second on that theme is everybody thinks fossil fuels are going away. And I was in a car dealership yesterday, and a Ford Mustang in Canada loaded up gasoline engine was $58,000. The Ford Mustang electric vehicle version now, it's kind of a crossover, it's more like a hatchback now, or a small SUV, is over 90,000. So it's $32,000 difference, almost 60% more than the gasoline engine. And yet people are still lining up to buy that car and pay that difference, even though there's never going to be a fuel savings for them. And so they want to help the environment, and that's pretty important. But I think what's critical to understand here is where this theme is moving. And it might not be the cars that you want to own. It might be the infrastructure behind the cars, because California is short of power, Texas is short of power, New York is short of power, Canada is short of power, Europe short of power, Asia is short of power. And we're really seeing a crunch into the energy crisis globally. Obviously, Putin's endeavors have changed the landscape for a few things: raw materials, oil and gas. So that's part of it. But we were actually on the road to an energy crisis before that. And now we're just kind of sharpening the axe on how hard the cut is going to be. And what we're finding now is not only a shortage of inventory in North America and in Asia, but the politicians still don't want to believe it, and they want to continue on the move to green. And yet, in order to get there, we need lithium, and we need copper, and we need steel, we need zinc, we need a whole bunch of different components that most people don't want to have mined in their backyard. So we're creating another energy crisis while trying to convert everybody to the new electric vehicle world. I want to talk about the indexes for a little bit, and then I want to go specifically into that theme and just understand that the theme will actually do better once the indexes start to improve, and we want to be waiting for that. So I want to give two things: the signal from the indexes, and then when the energy crisis charts start to pop, I think it'll be a great place to be. So first of all, I just want to show a couple of charts that I like to use, and I'm just going to minimize this panel. So this is looks very complex, but it's really just a vertical line every time we have an options expiration date. And there's a lot of lines on here, but all of the quadruple witching, which is the blue line, so that's the quarterly options expiration, and we just had one on Friday. All of the blue ones represent these quarterly option expiration days. And this was only a 2-week spurt. This was almost a month. But we've had some really nice runs off the back of those options expiration days. So they may wobble for a couple of days, but when they do take off, it can be really nice. So I like to use options expiration as a focus. And just because we've come off that, and then my next chart is a Fed chart. So we've got the Fed and options expiration within a couple of days here. That makes it quite an interesting setup, and that happens every second Fed meeting. But the main component here is we sit on the Fed date. The Fed meeting literally, we rallied on the Fed date, pulled back on June, and then on the Friday was options expiration day, and then Monday started the rally. So now that we've got the Fed behind us, I'm interested to see if we can get going. And what I've also put on here is the bond prices, and this is the bond yields. This is the yield for the 10-year. And what you'll notice is the June rally started as the 10-year topped out on June 13th. So this was kind of the Fed meeting. We came into it, and then things started to slow down. And you'll notice that pretty much when this downtrend ended, we're getting close to where the top was in August, and that this top ended up being the week of options expiration. So always want to keep track of those two dates, the Fed meetings and options expiration, for potential turns in the market. But I think as we sit here on Fed day, there's lots of dialogue around what's going to happen when the market can finally go higher. And I have a couple of charts that I want to share with you, and hopefully they'll help you understand the difference as to what I like to look for in the market. And again, I'm a longer term strategic thinker, so I do not try to day trade at all. I literally have positions that I put on when the market's in my favor, and when the market's not working for me, I'm either out of most of my positions or working them through some sort of a hedge to try and hold them through a market downturn. So anyway, the two important dates I think in the market are always the Fed meeting and the options expiration day. And I think if you want to help yourself, just you could add those to your chart. Rich, who will just post them. There's only 8 Fed meetings, and the quarterly options or the monthly options expiration is every 3rd Friday of the month. So never before the 15th of the month, and never after the 22nd. So when you look at these two dates, I think there's a lot of time, a lot of rhythm there to try and be aware of. And how it works out is there's nothing saying it will change on that day. It's just an important day to consider and look for trend change. So this is the S&P 500 just over the last month and a half. And we've been in a downtrend since mid-August. This was options expiration day on the Friday. So you can just see we rolled over options expiration week, and we've pulled down, and now here we sit. We just had options expiration on Friday, and can we turn up with the Fed meeting here and start to break out? We had this sudden move in September, and then CPI data came out and we pulled back hard. And now what we want to watch for is, can this accelerate back up and start the process again? When we look at a year-to-date basis, it's a little more difficult. You could just see real rough. I've just drawn a line through kind of where support and resistance is, and this sits roughly where, let's say, off 19% for the year. The support and resistance line magically is about halfway from where we are right now, and so we'd like to watch for that and just see if we can get going. We also have a support and resistance area here where we were support, then we became resistance in here, and now we're support over here on the right hand side. On the S&P, that coincides with about a 3,900 level, and we want to continue to watch that level to just see if we can get back through it and hold support here. I do something a little bit different than most people do, and I have this trend line that I put on my Ppo indicator. And what the trend line does is it just keeps track of momentum. And So I'm going to try and find a better chart. Let me just find my Nasdaq here, Nasdaq 100. So what we see on this chart is the Nasdaq 100 momentum was declining really since August of 2020, but the market didn't roll over until the end. And what we see is we made a series of lower highs, and that wasn't very good. And then we really kind of fell off the cliff around 2%. When the market finally pulled back, then we had this downtrend, and now we're trying to make a higher low in momentum. Now, whether we will or we won't is still out for debate. What we want to watch for here is a change in this momentum trend. So we have a high in here, a low, and now we've got a lower high over here. But what we'd like to make is a higher low and then start to work our way up on the right-hand side of this base. So typically what happens on a longer term time frame, if you don't have, I'll call it abnormal events like COVID, is that you would be able to see the market momentum starting to change. And if we look, I'll just wind the tape back here to 2008 and 9. What you see is in 2009, so 2008 was the real plunge in the market, and then we rallied briefly and we pulled back. And on that pullback, we made a significantly higher low. And it's that higher low that we're looking for now that the market has had a 35% correction, which is a pretty big correction. And it's what we had in COVID, but in COVID, the Fed and every municipality and every provincial and state government and every federal government around the world threw money at the problem because they all wanted to stay elected. And the central banks also wanted to try and keep the economy going. Good goal. They were successful. So that literally gave us a V rally. Well, if the Fed's not going to help us, we're probably not going to get those V rallies that are as sharp. The market's going to take some time to figure it out. So what I'm looking for here on the right-hand side, and I never want to be too pessimistic. It always looks bad until it finally changes. And then you're wondering, gee, I wish I would have bought that low. But really simply on this chart is a couple of things that you can add on this PPO, and you can just show that there's trend lines along here. And when those trend lines break, it's a pretty important thing to watch for. Now, the PPO is this one's a little bit long and flat, so I might just go up like this. But the PPO in general is a percentage version of the MACD. So if you've heard of the MACD, that's been a real common indicator, probably one of the top 2 or 3 indicators for technicals. The PPO is a percentage-based version of that. And the idea behind it is that it changes because a MACD will make higher waves on every one of these lows because the price is higher. What we want to do is we want to change it to a percentage change, and we're watching for a change in how the market moves. But literally when all of these breakouts occurred, these were nice buying opportunities that you wanted to enjoy. And so as we sit here at the low, we're actually at one of the nicest opportunities coming. And now what we're waiting for is, does the market resolve lower? Does it roll over and break down? Or can we start to rally from here? And it's that higher low concept that I want to show you that I think is particularly important. And if we could start to break out, that would be helpful. Now, again, I'll just go back to that shorter time frame. So we have this wave in here that's not obvious on that long-term chart, but we've made we could draw a line right across the top of these. And if we could start to break out of that, you want your trend to be at least a 4-month trend, preferably a 6-month trend. So I'm just going to set this here. And for me, what I'd like to start to see now is that this turns and accelerates higher. We don't know if it will, but that would be the optimum to try and get the price to start doing what we'd like. And hopefully we can add this line over here now and get price to move forward. So we have a low here, another low. We're trying to make a higher low. And if that's successful, then this is going to be a very nice entry. And it's actually quite shocking if you go back and look at a lot of the charts where this PPO trend line breaks is so close within a week or two of the actual final lows that you get a nice break to the upside and you're one of the earlier buyers. So other buyers are going to be sitting here waiting for for a longer trend line to break, perhaps this trend line here, and they're going to wait from 12,000 to call it 13,000 or 13.2. And if you're starting to see the momentum pick up here, this is going to be a pretty attractive place to start looking. So you might find an extra 1,000 points on your rally. So that's one of the ways I like to think about the market. Again, I'm not a day trader, so you know, what the Fed does this afternoon and how the market responds tomorrow, I'm probably not playing that trade. I'm looking for when this big picture changes, and then I want to really put my money to work and try to make sure that I'm catching the next big uptrend. So if we go look at something like even the Dow Jones Industrial Average, what we see here is this is a monthly chart, and you can see that the PPO for the most part stays above zero. So we're kind of at the lowest dip level that we've really had since the 09 lows. And what we want to make sure of, obviously, is that the market starts to bounce here. If this enters negative territory, that's what we did in 2002 to 2000 or 2001 to 2003. And in the second half of the financial crisis, from the top in 07 roughly until May, and then in May what happened was Bear Stearns failed, and then September we had Lehman Brothers fail, and so that kind of started a cascading waterfall. We haven't really had that second hammer come down yet, and what we don't want to happen is to find out that all of a sudden we have a debt crisis where high yield and corporate bonds have a big problem. And if that problem happens, then that could cause the acceleration lower of the whole trend, and really change the complexion of the uptrend that we've been enjoying since 2009. So to me, this PPO is a real helpful guide. I said I'd talk about my favorite indicator. This is definitely one of them. You can use it on short time frames, like a 5-minute chart. It will behave the same as a MACD on a short time frame. But if I was to post a MACD chart here, what you'll see is that the MACD makes much bigger waves over here on the right, and the reason for that is the price is higher, and because it uses price for the calculation, the waves will always be bigger on the right. And if you go see Amazon or Apple, that will definitely play out. And what the percentage change does is it actually shows that back here, this was a bigger percentage move in the late 70s than the percentage move we've had recently, even off that COVID low. So you can imagine this was a pretty frothy time back there, where the market was just moving up in leaps and bounds. We've still had a very high level. Our momentum indicator got all the way up to the best in 20 years. I think that's pretty solid. So we've just gone through one of the nicest runs the market can have. The real question is, can it hold up, or do we, by this change in interest rates, will it end up pushing so far that we start having, 1,500 companies drop off the indexes because they've got debt problems and all of a sudden they implode? If that was to start happening, these charts will all start to change meaningfully, and we'll probably see the change in behavior show up on this PPO indicator, kind of indicating that we're now going below zero on a monthly chart. That's a horrendous place that we don't really want to be invested long in, and we'd like to just stand aside. So that's one of my tools for trying to make sure in the big picture you're on the right side of the trade, and trying to day trade through that will be very difficult. You'll have lots of volatility to work with, but it might not, again, volatility cuts both ways. So that's kind of one of the big pictures for me. I'm a Canadian, so I own property in the US and own property in Canada. But the idea being the Canadian market is a small market married to the US market, with a lot of our exports going to the US. And so we have this setup coming up right here, right now, that we want to watch for. A small market like Canada is going to react differently than the big market like the US, because you can move between sectors so much better in the US. We have some sectors almost non-existent, like our healthcare sector is relatively small because it's all government owned, whereas your healthcare sector is quite remarkably different. What we see on this is we've got a big downtrend in momentum. I've got a 200-day moving average you can see rolling over here. So it was support. Now it's been resistance. We're trying to make higher lows here and come out of here. So if we can bounce here, that's very important. And again, you want your PPO to kind of stay in positive territory. So after running up and pulling back, give it a little bit of time to work here, but we'd like to see this push higher. And if this can start to break this big downtrend, if Canada can start to break the downtrend, we'll probably see the US market doing the same. So I'd use it more as an indicator. Canada usually moves a little bit before the US market, typically both ways. What's interesting is because of the strength of the oil and gas business in the first quarter, the Canadian market held up a little bit better than the US market, whereas we would have failed. Our high would have been at the top in November, probably had we not seen an invasion in Russia or in the Ukraine. And that kind of propelled all of the material stocks higher for a period of time. Anyway, the market's rolling over here. What we want to watch for is, can we start to turn this higher and get our momentum indicator back into positive territory? And if I just open up this chart a year, what you'll see is it stays in positive territory nicely. We started to get questionable after the first dip in below zero. And this is kind of one of my warning indicators. You dip below zero, and then that kind of marks your final high. And so doesn't always work out, but you should definitely be on the lookout for it. Again, then we just kind of wobbled sideways for months and tried to make it. Now what we've had is we had that downtrend in momentum. This is a daily chart. A downtrend in momentum break, we rally. And now the real question is, if we could bounce here and start to work higher, this could potentially be the big setup like we had coming back. I'll just try to add another period of time here, the COVID period. What you see is we dipped below zero, and then when we broke this downtrend, that was a pretty nice place to get on board. So if we could do the same thing here and start to change the momentum to an up cycle, that's really going to help us get going. So the Canadian market is a small market, but it can also help verify the moves we see in the big market. Now I want to cover off two charts that I think are of particular importance. If you haven't seen my work, it's typically, I do a lot of analysis on a Saturday, going through 500 or so charts, trying to see what's going on, and I go through the commodities, currencies, bonds and equities, and crypto, and the idea to try and find what's going on, where the big move is. And I have two charts that are quite simple, and I want to make it very clear, nothing is in stone as to how the market will change. But if I just showed you this chart, and this chart shows a big downtrend, and roughly about November, December, January, started to change into an uptrend. On my charts, a purple area chart is always the relative strength chart, and it's always compared to the S&P 500. The S&P 500 is a large gathering of 500 of the largest stocks, and what it also has, though, is a really good sector representation throughout it. And so as people move from one sector to another, we get a better feel for the economy. But if people are continuing to have the XLP outperform, so staples, outperform the S&P 500, this market probably isn't ready to change its tune yet. And when we were in the big bull market, what we had was staples were still going up, but they were underperforming how fast the S&P 500 was going up. And so it's that change in behavior where, let's call it, the S&P is going down, maybe utilities and staples are just going sideways, but they're still better than being in the S&P 500. Well, when the world changes back to bullish, what should happen is we don't really want to sit in a safety stock like consumer staples or utilities. We'd rather move back into growth. So we're going to move into XLY and XLP or XLK, perhaps XLC. We'll probably see materials and energy do pretty well just because of the dire situation for those areas of the market in terms of inventory. But this simple trend change, just watching for this change in trend between the XLP and the XL and the SPY, or the $SPX, the S&P 500. So the S&P 500 doesn't have dividends included, and the SPY does. So it's a subtle distinction, but it adds about 2 or 3% to the SPY. So the simple thing will, if you could track it either way, but my point would be just understand that there is a subtle difference there. So I'm not giving the SPX the benefit of the dividend, which consumer staples will have. So it's coming down here, and then it takes off to the upside. When this trend starts to change, that's probably a really good place for us to look. And you know, in early December, this started to flicker higher. So that's something, just a simple awareness tool, that when that changes, and you can see, you know, consumer staples haven't been anything to invest in since that period either. But the important part was you're all of a sudden starting to see a change in what institutions wanted to own, and they were leaving tech and they were moving into this. That's very helpful to see. Now, XLU is also a defensive area of the market, and we have a similar, not quite as elaborate model for that. It didn't work out quite as cleanly, but what did work out, sorry, a printer just turned on beside me. What did work out was that the whole downtrend of the utilities underperforming the S&P 500 all the way through the year of 2021 really changed in 2022. And so we see this big change in momentum happening right at this point, and all of a sudden utilities really started to outperform. What I would like to see happen when the market changes is I'd like to see XLP and XLU start to underperform the SPX. And again, that's taking in the difference of the dividend. But what will happen is it should start to show actual price behavior in the S&P 500 changing enough that this chart starts to move down, and that should really show us that the market wants to move on to a bigger picture. That would be very, very helpful. So for me, those are kind of some of the clues I like to work with. I like to work with this PPO, and on a weekly chart, it's not as comforting. If I took this chart to on a daily chart, it's not as comforting, but on a weekly chart, what you can see here is this big downtrend where it's definitely underperforming the S&P 500, and then you've got a big uptrend. It's when this uptrend changes that we probably want to be aware. Now, back in 2019, utilities were doing pretty well, and one of the reasons they've been doing better than consumer staples even is the move to green energy. So if we can get that, you know, solar fields going up and the wind farms and that kind of energy infrastructure getting put in place, some of these utility companies are going to do pretty well. And they also make a lot of their money right when power generation is at its lowest level. So it creates a real problem for them, that or opportunity for them. Probably their 10 biggest revenue days are the worst days for all their customers. So a shortage of energy is going to help XLU a lot more than XLP, but so going to help utilities more than consumer staples like a you know, toilet paper company or something. So we're going to see the change in behavior show up on these types of charts, and that should be helpful. But you'll also notice, if we go to the S&P 500 real quick, just looking at the PPO, we're below zero again. If we can start to turn up, this is a real important inflection point. I don't know if it's here yet. It might just roll down and we might stay down here for another year. But what I'm watching for is that change in behavior, that all of a sudden we start to see utilities, consumer staples start to underperform, S&P start to outperform, and that's going to give us a real lever to the upside. You also notice on the full stochastic that in a bull market, you typically get a bounce around the 50% level. So we spent all this time below 50%. We had a brief rally up. If we could turn up right here, right now, that would just say that the market is now changing behavior and we're starting to rotate higher. So I have some optimism that we're near the end of the death spiral and the market is going to respond long before the recession is clearly in our face. So the market will be looking for the end of the recession, not looking for they won't be worried about prices continuing lower or job layoffs continuing down. The market will have priced that in well before, and they'll already be starting to push up some of the bigger companies. So those are some of the clues I want to look for analyzing the overall picture. And I don't want to get too excited about buying anything until that overall picture really starts to improve. Now, if you're a longer term investor and you're looking for when to get back in, I think those clues are the ones I just identified. We can also use other timing tools, and I've given Sherry a link to a presentation I did yesterday about how we do it at Osprey Strategic. So I'm not going to go through that whole thing with you today, only to say that you're more than welcome to go check out that slide deck. It's about an hour-long presentation, maybe 50 minutes, and it'll just show you some different ways that I try to analyze the market. I think it's a pretty unique view that will help you stay on the right side of the trade. So in my opening discussion, I talked about the energy crisis, and I don't think most people are aware of just how short we are of oil and gas, and maybe a lot of you are, but the real problem is that our production rate is not accelerating fast enough for global growth with the number of people on the planet. And really since 2008, when oil topped at $149, governments have made a meaningful push to try and embarrass, slow, stop, do whatever they can to get away from producing oil and gas. And while that's a noble achievement, it's really important that what we need to think about there is the change in direction that we're trying to incur. So until we build out the solar and the wind so that, California is not telling you you can't have a gasoline car, but there's not enough power to charge your Tesla, all within 3 days, it's just remarkable. We really have to get to this point where we're going to go through this energy crisis, and the governments are either going to flex and say, oh yeah, we still need oil and gas, like Elon Musk said, or we're going to go through a much bigger problem where everybody's short of energy and we're back to the 70s where we're waiting at a gas station for our allocation. We're really at that physical fulcrum for energy. And obviously, if you're in North America, you probably have better access just for a couple of reasons. One is the wealth of the economy can bring it to you. But if you're in nations like Africa, they're definitely struggling. They will not have enough energy to get them through the winter. And obviously Europe, I think Europe, we now expect that they'll get through the winter. It won't be easy. They'll be running their temperatures a lot lower in their houses than they would normally to try and meet that season-long goal. But all of this sets up for a major opportunity in energy to be invested. And as we push out the other side, let's just say that the market does start to make its lows here. This will be one of the biggest infrastructure spends ever to try and get the grid up to speed to move to electrification. So long distance transmission lines need aluminum, so you're going to see companies like Alcoa do really well. Copper companies are a big requirement. And you'll see companies like Freeport-McMoRan and Southern Copper, BHP, Billiton, Rio Tinto, Vale has steel mining, a company in Canada called Teck Resources, but obviously a big company around the world as well. They have a big copper mine coming on in Chile that's doubling production next year. So if you're looking for one of these companies that actually should double revenues, Teck Resources is a pretty interesting one. They also make metallurgical coal for melting steel. So these companies are going to sit there and they're going to be in the background or the blast radius of this whole environmental movement to try and bring power to the people in their homes and in their cars. And as that transition happens, one of the exciting parts of this will be investing within the blast radius. So all of these material suppliers are going to be pretty critical. The steel companies that make the power wires or the power stands and windmill stands, that type of thing, all of the infrastructure around this, road builders, so Caterpillar and all that, to go out and check your wind farms. And if you've driven between Phoenix and Las Vegas, you've got the Hoover Dam there. And what's really interesting is as the Hoover Dam water levels have dropped, what's happened is they've built seas of solar panels and wind farms out there, and they're using that grid connectivity at the Hoover Dam, the close proximity to it, to tap into all of those existing transmission lines. So I think it's pretty interesting to see how it evolves, but obviously the solar panels are one way to play it. But there's another whole regime going on here in the energy crisis that should help us. And when we talk about this, we don't want to get stuck in one industry group. So this might be energy, but it's actually materials that we're starting to look at. And then it might be technology, which is some software companies that do grid management and power demand management. So we want to try and invest across the theme or the blast radius of this whole thing, rather than just saying we want to invest in a Tesla. And I think this could be very, very helpful. So if we look at copper, and you might remember the trend line that I showed earlier on your PPO momentum. So when this starts to break out over here, and let's call it a month away, if this started to turn up and break this big 2-year downtrend or 1.5 year downtrend, it's a very meaningful place for us to want to get back on board for this energy crisis. And again, picking stuff up as your PPO is crossing below zero was a beautiful thing to do in May of 2020. You know, that was a pretty stellar ride. We have this big downtrend in momentum. If that starts to break to the upside, I think there's huge levels of optimism that we can carry from there. So it's a simple little tool, just taking this PPO and kind of giving yourself some a timeline or an area where you might start to see that larger trend break. It's remarkable how many times the market waits for that long trend to break. But one of the first clues is the Ppo Cross. And this has not quite crossed yet. You can still see it's negative over here. So on your PPO, it will be like your MACD. It will give the value of the actual line. It will give you the value of the signal line, and then it will give you the difference between the two. When this turns positive, then your PPO line is above the signal line, and that's a pretty bullish place. So as we sit here and test the 10-week line, I want to be aware of that. And you'll also know the full stochastic is trying to make a higher low here. So as desperate as everything sounds, if all of a sudden the market wants to start to turn higher, I'd look more to the consumer staples than the utilities, because the utilities might benefit from this exercise of the energy crisis. But that if that consumer staples line starts to break, you start to get a turn on the momentum indicators for the indexes, and you start to see some of these long trend lines break, I think it's going to be a wonderful place to step on board for this whole sector. And I used this tool to try and find the renewable energy, I want to say in early 2020, as we came out of the COVID lows, and finding a lot of those companies that were lighting it to the upside. But many times you can either just look for this PPO cross on a weekly basis, or you can look for the weekly PPO line moving above zero, and that can really help. In my macro work at Osprey Strategic, we try to keep track of how many things are in a big uptrend, where they are relative to zero. Are they making higher lows? What are they doing? And that tries to give us an idea of when this whole market's ready to thrust. And it's so much easier, and you'll probably have noticed that if you were in on the thrust off the 2020 lows, you were making lots of money. It's been a lot harder when the indexes are pointing down. Day traders might be doing okay at it, but unless you want to day trade every day, and I don't, I like to find the big moves, put a lot of money to work, and when that starts to head higher, I want to be a part of the game. So that's kind of my motto for how I like to approach the market. I want to continue with a couple of things. This is Alcoa. Again, they make the transmission line.
I hate to interrupt you, Greg.
Sorry?
I'm so sorry. Unfortunately, we have like 1 minute left because we did get a late start, and I tried to let it go a little longer. But I do have a person, Stephanie is in the room with us, and she's asked you a couple of questions.
Sure.
And I wonder if maybe she should email them to you. But one of them was, what is SSHIH?
Yes.
And Greg, so what security types do you trade, and in which time frames? This could be quite a large answer. And then Greg, then why have materials suffered of late? So I don't have any context for that, except she just said that.
I could answer those very eloquently. If you'd like to, I did do a presentation and I've given Sherry the link. So you can head over and check out that presentation
Awesome.
and it will go through how I use all of that. And it'll probably give you a better idea why I'm waiting for the indexes to start to turn up for the rest of this. With that, I'll let you go. Thanks, everybody.
Well, Greg, could I ask you one more thing? The presentation that you're referencing is the YouTube link, right?
Yes.
And then I also, do I want to go ahead and give them your link for Osprey Strategic right now?
Sure. So I normally charge about $860 a year for the Osprey Strategic. That's the most affordable option if you buy the annual. What I said to Sherry today is that I do have one called ospreystrategic.org/explore. And if you go in there, it would change the $860 annual member to $497. So that's a savings of roughly 40%. So if that interests you at all, I'd be happy to have you as a client. But again, sorry, I've run out of time. I thought I had until 1 o'clock, so that was my mistake.
What time zone are you in?
Sorry, I'm in Mountain, so I thought I had until noon. I thought I had until the top of the hour. It was my mistake.
Okay,
Sorry.
I'm sorry about that. And you know what? After you got started, I thought, oh, I should have mentioned that. Will you please come back again soon? I appreciate your presentation, and I know that people here are going to be taking you up on your offer.
Super. Hopefully I've helped out a few people, just some ideas of where to find the end of this downtrend and make a little bit of money on the upside.
Okay, thank you so much. I appreciate it. I hope you have a wonderful afternoon.
Thanks, everybody. Bye-bye.
Bye-bye now. All right, folks. That was Greg Schnell with Osprey Strategic, among other things. And I know that you're going to want to take advantage of his offer and go check out his presentation as well, because it's very complete, and you're going to want to take advantage of it. Let me just get myself back to where you can see my screen. Yep. Okay, so next up, and let me just do a little housekeeping. Please go to tradersexclusive.com/archived_webinars/ to see all of our trading webinars, so that you can see everything that's gone before. We also have a ton of information on our website that you should take advantage of. And now I'd like to introduce to you Melissa Armo of the Stock Swoosh. Thank you so much for joining us, Melissa. She's going to talk to us about earning 20K a month shorting. And I wanted to let you know kind of sort of a little bit of her background. She may go over it a little bit. And let's see. She's the founder and owner of an international educational company where she teaches people how to successfully trade the stock market. She owns the method she teaches and created it, which is unique to the Stock Swoosh. The method is based on one strategy called Golden Gaps, which pinpoints institutional money in the stock market. She's also the executive producer and creator of her own television show, which is titled Make a Million with Melissa. Make a Million with Melissa is a what to do and how to do it television show on stock trading. She also appears on TV as an expert stock market analyst, discussing the markets, stocks, news, and world events on Fox News, Fox Business Network, RT America, Cheddar TV, and CBS News Corporation, among others. Thank you so much, Melissa. It's always great to have you back. Let me see if I can work some magic and make you a presenter. Yes. And do I have you muted? Nope,
there.
you're unmuted. Good deal.
Let me know if everybody can hear me and see the screen.
Yes.
Good day.
How are you? Good to see you. Thanks so much for being here.
Oh, thanks for having me. Welcome, everyone. What a great day to do a webinar. Sherry timed this perfectly today because everyone who trades is watching the market today. Why? Because in exactly about 8 minutes, we're going to find out what the Fed says about interest rates. There will definitely be an interest rate hike today. And I know with this platform, we can maybe go back and forth. I might have to take it on and off to look at the market, or someone can tell me what the market's doing. But the market's going to have a move in the next 2 hours. It could happen right away, 5 minutes after 2 o'clock, and it could carry through into the close. So it is really an interesting day to trade, specifically because what I do is based on stocks gapping. But specifically today, we're going to talk about shorts. And I heard the tail end of the last conversation, the last speaker. It's very interesting. I'm going to be contrarian. I do not think the market has necessarily made new lows for the year in June 16th, June 17th. I think there's a huge possibility that the market could fall off for the year. I am not looking for long opportunities whatsoever at all. I'm looking for what? I'm looking for shorting opportunities, because that has been the play so far this year in 2022. And the interesting thing is that a lot of retail traders, I mean swing traders, I mean day traders, I mean long-term traders, even investors, are preferred to go long. They really, really do. And while 2021 was a very, very bullish year for the market, in fact, you could have gone long virtually anything last year. You could have gone long strong stocks. You could have gone long weak stocks. You could have gone long the market. And we power trended up very bullishly in 2021. Personally, I thought that was unusual. Part of it was the COVID recovery, okay? And people getting back on their feet and businesses opening up. But really, when you look at the backdrop of the economics, what was happening in 2021, many of those jobs that were added and much of the data that seemed to be better and better and really was positive data was really just people going back to work since before COVID. Really wasn't jobs added, okay? It was like just people going back to work. Why has the market been falling off this year? Again, I do speak on TV, as Sherry talked about. On almost every segment I've done this year, on every single channel that I appear on, we've been talking about inflation and the possibility of recession. And of course, Jamie Dimon actually came out, I think it was this morning or yesterday, and made a statement that he thinks not only are we going to go into recession, but it could last longer than people think. Some people are thinking that we're not even going to go into recession. Okay, so the Fed's job is to keep unemployment low and to keep also inflation at 2%. I think we had interest rates too low for too long, and now they're failing at the latter. So whatever they end up deciding to do today, I wouldn't be surprised no matter what the market reaction is. What do I mean? We fell last week, and because the market expected a 1% rate hike, which they originally said was 75 basis points. I wouldn't be surprised if the market rallies today, no matter what it does, because we sold off last week based on the reaction that already happened. However, if in the data today, or if in the Fed speak, if you want to call it that today, when Jerome Powell talks, if he says something that makes the market nervous about the future, going into the end of 2022 or 2023 with more rate hikes or bigger rate hikes, then the market may react negatively. So again, if you're flat positions, I think that's a conservative thing to do right now at 156, because you don't know the reaction here. But today we're going to talk about shorting. We're going to talk about gaps. And again, I'm not saying 100% conviction the market's lower this year, but I'm saying I definitely know the market will not make a brand new all-time high before the end of the year. Therefore, why would you go long? If there's a big possibility that the market could continue lower for many reasons, not just inflation, but what's going on around the world with Russia and Ukraine, specifically with oil prices too, then you have to be aware of the fact that going long here could be very dangerous for your long-term retirement accounts or for even short-term plays. But we're going to talk about gaps today. I'll explain to you what that is. And of course, we're going to talk about making money. And like I said earlier, this year has been a great year to short. If you do not know how to short, you are missing out on a lot of good moves this year in stocks and the overall market. So for those of you that don't know me, again, my name is Melissa Armo. I appear on TV, and I also run a live trading room every day, and I teach a class once a month on my method. If you'd like more information, you can email me at melissa@thestockswoosh.com or call me at 929-3200-GAP. You can also follow me on Twitter, Facebook, YouTube, or Skype, where I post when I'm going to be on television and also have some of my most recent hits there too. So this is what I wrote this morning and I sent out on my email today. I basically said that I don't know what the Fed's going to say, but I know that the rest of the year is going to continue to be volatile no matter what they say. And I also said, with what I just said earlier, that it has been a very difficult year for traders who are looking for stability. Traders tend to want to find stability or trend trade. It hasn't been a good year for that, all right? And again, we can go back and forth at what stocks are strong this year and what stocks are weak this year. One of the strongest stocks, I think, this year is CBX, which is Chevron, which is oil. Okay, but even that stock has been volatile to trade this year. It's sort of like you have to be in and out it, because when it's had some down moves and some up moves, okay? But everything that I look at is based on the gap. And a lot of traders look at indicators. The indicators really don't help you that much when you're against the trend. And when you're having this type of volatility, actually, it can hurt you. You think something's holding on support based on the moving average and or Fibonacci or whatever indicator you're looking at or using, and all of a sudden it doesn't do that. And then all of a sudden you're up in a trade and you're down in a trade. But really, for me, I never make trading decisions based on those things. I make trading decisions based on the gap. It's a price action in the gap. That allows me to have accuracy in the trade. And obviously, we're going to be here today live while I'm talking. This is perfect timing to talk and see what the market reaction is, which I can bring up. So I plot this in here. This is year-to-date results for the day trade room, live room, with an average risk of about $2,800 per trade. If you've been in the room this year from January through yesterday, 506,702. These are all day trades. Okay, so these are active day trades. These are trades on margin. We trade stocks. We trade stocks based on gaps. Most of these trades are shorts. Some are longs. Okay, we have gone long. I'm not opposed to going long. Some have been longs, but I do prefer to short. I prefer to short in any year at all. I love to short. The reason that I love to short is because a lot of traders don't know how to short. So I feel that shorting gives me a niche. But the fact is that trading is a real job if you really want to do it, full-time or part-time, even though it's really part-time hours, if you take it seriously. And I think a lot of people trade and they say they take it seriously, but they really, really don't. What do I mean? They're taking pot shots or 50-50 when they're risking money in trades. Day trading, though, really is a part-time job with full-time pay if you want to do it. But you've got to be focused on one strategy to be effective and efficient, and it should work in any market conditions. Again, a lot of things worked last year because of the fact that the market was strong, and so people love to go long, and if they went long, in fact, they made money. But again, it's one of these things where you need to be able to make money in bullish markets and bearish markets. So I found that having the edge of shorting, okay, which is what I do, gives me the extra oomph, okay, against other people, over other people, to be able to make money in the market. And I think that if you're someone that's out there doing whatever and you're really not seeing the results, you're winning a little bit, you're losing a little bit, and overall you're down or flat, then you probably don't have an edge in what you're doing. And you do need an edge. You need an edge in order to trade. You need an edge, I think, in anything that's a competitive environment where you're out there. It could be a career that you're going after. Actually, television. So, you know, I started on television about 7-8 years ago. That's highly competitive. Anything in the entertainment world is competitive. Trading is competitive, okay? You need an edge. Anything that's going to give you an extra leg up so that you can be successful, because ultimately that's what you want, all right? You want to be successful. That's the reason you're doing this. And for me, one of the reasons I trade gaps is because gaps have a lot of momentum, okay? So you don't need to take huge positions in order to have huge profits. A small position can give huge profits with small trade size if you get a big move. So for example, say you take 500 shares of something and you short it and it drops $1, you can make $500. That's a good profit, okay? $500 a day is $2,500 a week. That's not nothing, people, okay? That's actually pretty good. So it's not like you have to take thousands and thousands and thousands of shares to make a couple $100s a day or even a couple $1,000s a day. It's basically momentum. I'm trading momentum, and I'm trading momentum in the gap. Momentum trading is one of the most profitable and fastest ways to make money trading. If you can learn how to take a position in a stock in anticipation that the stock will have an explosive move, that's how you're going to make money. You do have to get the direction right, all right? Momentum trading is very profitable, and that is how you can make big money in the market. How do you find this? How do you find momentum? Okay, I find it in gaps. So what is a gap? We're going to go over here. This is a trade that we did last week. This was a gap in what? This was a gap in Adobe. The Adobe stock closed up here the night before, then it had earnings and gapped down. So what is a gap? A gap is a difference with the close and the open. Every single stock, including the market, has, excuse me, a set close and open. The US market closes at 4 and opens every day at 9:30, no matter what. Closed weekends too, okay? So this was 4 o'clock here, closed around 371 or whatever and change. Gap down here the very next day, this was the 15th. So it was the 14th to the 15th. Adobe opened here around 323 or whatever and change, and we shorted it and it fell. Fell like a brick, actually. You can take it over here. I think low in the day was 305. We did a day trade in Adobe. Down here's the volume. We also did an option in Adobe. But anyways, this had a big move. So we were talking about momentum. $15, $20, that's a big move, even for a stock like Adobe. Huge move. Again, momentum. And you would have wanted to be short this, okay? If you were long this, you would have lost money. Continued down the next day and here, and actually was down again today too. So again, what is a gap? A gap is the difference between the close and the open. Simple. How do I know that this gap is going to go down? How do I know it's not going to go up and fill the gap? Well, this is what I teach in my class once a month. I developed a system to rate it, to determine in the pre-market. I saw this in the pre-market very, very early, Adobe, on the 15th. I look at it, rate it on the daily chart. This is a daily to determine that this, in fact, will go down. Okay, and that's why we ended up doing a short in it. And we also did a put. This was the newsletter put that I sent out. It was very low strike. So at the time that I called this, it was 9:52 in the morning. The stock price was over 320. It was a very aggressive call to see that it would head towards 300. That was pretty far away. But this was a really well-priced put. Okay, and this is a newsletter I have, and it was a put, you see here, that actually you still could be in. I got out of this, it was up too much money, but actually you could still be in it, and actually if you are still in it, you are still up. You can look it up right now and see the value. I didn't today, but I know it would be from where I called it. So on Thursday the 15th, I called it out for the following Friday expiration. Cost was $3. Contract number for an advanced trader risk was 25, risk 7,500, sold 1150. Again, this went even more because I know it continued down. Profit on this was 21,250, which was a 283% return on investment. I get this question all the time. Are the exits always at the low of the exit in a short or high in a long? No, that would be impossible to do. What is possible is to see this will go there or anywhere close to there and get in it early, and that's what we do. I don't always get the best exit, but when you're up this much money, you have to book profits. Again, you're chunking it out. If you're an active trader, you chunk it. And for me, a weekly option, which is what we focus on, to take a trade and get it in 24 to 48 hours, that actually is fast. Okay, that is pretty fast to me. For a beginner risk, if you risked around 1,200, 4 contracts, $3 a piece, you could have made $3,400. This is in 24 hours. It's a nice trade. Really nice trade for the amount of money you put on. And again, is the chat where the questions are, Sherry? Is that where the questions are? I'm just asking because I just want to make sure if I see anybody's questions, because right now I don't see any question area. If there is questions, if you want to put it up.
All right, I'm going to fix that right now. Yes. And just to
right now.
see. Can you see them now?
Yes, I can. There they are. There's the people. Somebody tell me where the cues are. Are we up? We down? We jiggling around? Someone can plop it in the room and I'll see it. Anyways,
this is your chance to interact, folks. Let's put some answers up there.
Nobody cares. Everyone's glued to the market. We can look at it when we're done. Maybe nobody's trading today. Anyways, let's talk about the footprints of institutional money. Again, what happened with Adobe? Adobe clearly fell big time, fell from the previous day, and then fell on the live day. On the live day when we did the trade on the 15th and September 15th, what happened with Adobe? Institutional money sold it. And there were people that were shorting it. Remember, big professional traders can short. Oh, we're down $3 in the market. Woohoo! Wow. Let's see where that goes. Again, it can be wiggly jiggly. Wow, we're down. So we're red basically because we were green earlier before I started this talk. So you're telling me now the cues are red. Interesting. anyways, getting back to what I was saying, we're looking for institutional money. So if institutional money, which is big funds, hedge traders, big professional traders, if they're going long a stock, it's very easy to make money to the upside. If they're shorting or dumping a stock or selling it, it's very easy to make money to the downside. This could be in a put or call. This could be in an equity trade where you go long or you short. Okay, so you could do whatever you want to do, whatever works for the size of your account. But institutional money means big money in the market. Okay, that's the whole point. Again, when you're looking to get something, you've got to have volume and you've got to have a big move. And the bigger the move, the better. Okay, that's how you make money and move forward. Again, everybody has losses when they trade. No system's 100%. Anyone that tells you that isn't telling the truth, isn't honest with you. I have trades that lose. But the whole idea is that I have more winners than losers. And some of the winners that I have are large winners. Adobe was one of those. So you have to have some of the big winners because they're going to cover the losses that you have when the trades lose, and then you move ahead and then can still make a good amount of money. You're moving forward constantly, 10 steps forward and then 2 steps back, 3 steps forward and 1 step back. That's how trading is. And again, you've got to keep your foot on the gas when you're moving forward and stay consistent with the strategy, which whatever you're doing. But it's always about who is in charge, the bulls or the bears, the bulls or the bears. Okay, here's the chart of the QQQs. I clipped this from, again, around 12:20 this afternoon. Someone's telling me we're down. I don't know where we're at now, 287 or whatever. Somebody said net -3. But here, let's just pretend we are -3 down here from where I clipped this at 12:20. We're red now, like I said, so we're snug as a bug here. So again, I don't know where we're going to gap tomorrow. Tomorrow's a very long day away. Okay, tomorrow's tomorrow on Thursday. We don't know where we're going to be gapping tomorrow. We could gap up or gap down. But as of right now, the market apparently has having a negative move to the downside based on whatever the Fed is doing. But you're always trying to look at and play what's happening on the side of institutional money. Back in here this day was the 13th of September. We did a bunch of what? We did a bunch of shorts and we did puts. And guess what? They worked. Let's go back and take a look at it. What's the gap? When the stock closed here, this was the market. Okay, this is QQQs, closed here, gap down. This is the particular day that we shorted. Again, we were talking about gaps and we're also talking about momentum. This is a large move. This is a sizable move in here. Okay, almost a $10 bar for the Qs. That's a big move even for the market. Someone's saying what? Oh, they only did 75. That's interesting that we're flying on 75. Interesting. All right, let's keep going, people. Great, this is great trading. This type of volatility, do you understand this is great trading? Again, you have to know when to go after it. This day here, we went after it hard. We just, we piled in here. Got the drop, okay? Same thing we did with Adobe. I'm not saying I'm never gonna go long the market again. I'm not saying that at all. I'm waiting to go long my retirement account, the market, but not right now. Not right now, and actually it may not be at all this calendar year in 2022. But the whole idea is to learn a method to spot institutional money because it makes it so much more easier for you to trade because you're gonna get a big move when the money comes in. So right now, again, someone saying the market's down, they could be selling off hard. Why? Because the Fed thinks it has inflation under control, but it really doesn't. We all know that it doesn't. If you go out, if you spend money, if you're a shopper, if you go to the grocery store, you've seen how prices of things have gone up. My God, butter. The other day I went to get butter. Butter has almost doubled here in Manhattan. I live in New York City. Butter, I mean, it just makes no sense, okay? But one of the reasons we're in a period of inflation and why I don't think raising rates like crazy is really gonna help is because the fact is that fuel prices are still way too high. I know they went down since June. Everyone says, oh, they went down, they went down, they went down. Yeah, the thing is they went down since June. But if you rewind from a year ago, they've gone up dramatically from 12 months ago, which really wasn't that long ago, okay? So everything I'm looking at is to follow the institutional money that's happening in the market. And then I'm capturing those moves in a small time frame on the daily and on the 1 minute chart when we're doing the day trade. So we did a 1 minute chart day trade on Adobe where we shorted it, and then we did the put, which again, you can take overnight trades with options, which is where you can get the bump. You can get the bump overnight if you're in something to the downside or the upside when something gaps in your direction, which is very, very profitable. But institutional money is in charge. It's in charge of the market and the stock at all times. Even if you think it's not, it is. A big flow of money going in a certain direction is what moves the market, stocks, and creates momentum and sets the trend in charts. Again, a lot of people have been trend trading this year and it's not working. Why? Because when the market falls, it's very hard for anything to go against it. When the market rallies, it's very hard for anything to go against it. But particularly when the market's falling, it's going to drag everything down. I bet right now, if you pulled up your scanner, if the market's falling off a cliff right now, I don't know, but if it is, I bet there's red everywhere on everything, even stuff that's strong, okay? People love to buy dips. They've been doing it all year for 9.5 months. They're still not giving up on it, and they're getting killed, okay? Again, shorting is a niche, but you can't short everything in the world, and you can't short the market every day. You have to know when to hit it. And particularly when you're doing options, I mean, you not only do you have to have the direction right with an option, you have to get the timing right. Because if you take it in the right direction and you blow out in the time that you're in the trade, you may lose in the option even if you get the direction right. So you have to get timing right for options too. And you also have to get timing right for day trades. Why? Because if I'm in and out of a day trade, particularly I like to be in and out quick in the first half hour of the day, I got to get out of it still before 4 o'clock, or it turns into an overnight trade, which I don't hold my stuff overnight for the equity trades, okay? But when you're looking for institutional money, you're really reading the side of the power in a stock. You want to be on the side of power in order for you to make money trading. Institutional money is in charge of the market and stocks at all times. Even if you think it's not, it is. So becoming a successful trader and investor really requires becoming a specialist. You have to become an expert. You need a strategy that you're going to focus on every day. Where is the buying coming in? Where is the selling coming in? And for me, it's based on gaps, but it's really based on advanced technical analysis. So whether or not, whatever the Fed says, it's not going to play a part in my decisions tomorrow morning to take my positions. I'm going to look at the gap. I'm going to look at the price levels, okay? It's technical analysis. What is technical analysis? Technical analysis is looking at past price data to predict future price data. That's how you do it. So comprehending how to read, define, and trade with this power will have a huge positive impact on your profitability as a trader. Elevate yourself, your trading, and your profits to a higher level of consistency and success by learning how to read the footprints of institutions trading in the market. If you can learn how to read what they're doing, what the big position players are doing before the big move happens, before it even occurs, okay, you take the position in the right direction and then you get out after the move happens for profit. And that's the whole thing, okay? Knowing how to read what institutional money looks like is essential to becoming successful. Again, how do I do that? I do that in gaps. So what is a gap? We were discussing this earlier. Again, for some of you, this is new. For some of you, this is you know, a review. What is somebody saying right here now? What's up 15 points? Something's up 15 points now? What is a gap? A stock gaps on the opening price today is different than the closing price of yesterday's trading. A gap is a break in price action from one day to the next. Simple. Again, what is a gap? So let's go back here and take a look at it. What happened this morning? The market actually gapped up. Market close here yesterday was Tuesday, gapped up here on Wednesday. So we closed at one price and opened at a higher price. What did we do over here? We talked about this gap. Market closed here, gap down, fell. Market closed at one price, opened at a lower price, okay? Now you can't short every gap down and you can't go long every gap up. And actually we did not go long this gap today. Part of it was not knowing what's gonna happen into the 2 o'clock minutes, okay? Part of it was we're really not in a good area here, in reference to the overall market. Let me see if I can find here. You could have gone long this gap up. Market closed here, gapped up, rallied. You could have gone long as a day trade here or done a call on this particular day. This is a pretty decent sized bar here. Again, this is the QQQs. Here was another gap down. Market closed here, gap down, fell. Market closed here, gap down, fell. Okay. There's another one over here. Market closed here, gap down, fell. Boop. So again, I'm looking at the gap, I'm rating the gap. Here's the SPY. Again, I look at the market indices, even though we don't necessarily trade the market every day, but I do look at them. They've been very similar and the same. This was an option that we did in the SPY. This was on August 26th. We did the 415 puts, let me find it, that expired on the 2nd. 26 was here. So we did the 415s. See where the 415 is, dropped, fell through, boom, 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 boom. Again, it expired on the 2nd. I'm not a, you know, you don't have to hold it the last day if you're up a lot, In this case here, you could have held it into the last day and still been up. It fell into 390. That was the 415 puts. Cost was $3. Again, 25 contracts, 7,500 risk, 1850 out, 38,750. Return on investment, 517%. Again, getting the direction right, getting the timing right, getting in early. This was 10:05 in the morning on that Friday. And I saw that we would drop and have a big move. And then it's exactly what we did. And we had the follow through. We had the follow through for that whole week. Again, it seems like a long time ago. It's almost a month ago now. Look where we've gone since then. If you had a beginner risk 1,200, you could have made 6,200. Again, solid trade. For people that have small accounts and want to trade options, you can really bang it out the profits if you're getting in some of these moves where you're capturing this type of momentum. It's the way to grow a $5,000 account into a $10,000 account or a $2,000 account into a $5,000 account. When you're taking this type of risk and getting this type of big momentum, this is a huge, massive bar. And again, you did have the follow through if you wanted to hold it down too. Okay. And again, where are we now? Wherever we are this second, whatever the SPY is doing, again, I don't know, wherever we are right now, we're nowhere near 215. And that was a month ago, people. A month ago, people. You see? Any questions here so far? Getting back to what I was saying though, Golden Gaps had huge opportunity because they spot power money. Again, the money could come in to dump it, selling or shorting, or could come in and scoop it up and buy it. And you could have longs. Again, I prefer to short, but you can do either one. So let's look at another one here. We had FDX. This was a really big one. What happened here? Stock closed here the night before. Snug as a bug in here, 205 or whatever. This was last week on the 15th. Gap down here on the 16th and fell. Where did it open? Slightly here around 160. See it? So I don't know if anyone heard what the FDX CEO came out and said. He was going to say we're going into recession, things are going to get bad, things are going to get horrible, and everything else. And again, it was like a pre-earnings that he came out with, said forecast. This was a trade I had called on September 7th, heading into that week, that actually expired on the 16th. It was the 195 puts. I called it at 10 a.m. on September 7th. So let's go back. September 7th was here. Okay. Then it worked. So it opened that day. It was like 35 points for the strike. As soon as you got up in the morning, everybody that was in it that did the trade was up a lot of money. This was not half bad for the cost. This was $3. Contracts 25, 7,500, sold at 37. This is on Friday, September 16th. Profit was $77,500. It was 1,033% return on investment. This pretty much made everybody's month that did it. For the beginner, if you took 4 contracts and was $1,200, you could have made $13,600. Did people do that? Yes. Yes, they did. So again, this was incredible. So here is where the stock was, and then here's where it opened. So again, it was a huge drop. We were in puts. It fell through the floor, okay? And that's, again, momentum, 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 momentum. So there was a gentleman that recently signed up for my newsletter. He was ecstatic. He was literally on it for like a week. He was literally on it for a week. I'm not going to read his whole email here, but he did do extremely well. And he was, you know, absolutely thrilled. So he did not do the class yet. He's going to do the class, I think, in October. He made $13,837. He did 4 of the FDX puts. He got a little bit better price in the fill when he took it. It's completely fabulous. Okay, for somebody this new, within the first, you know, month of signing up for the newsletter, to have this kind of a win is great. So he paid for a subscription, paid for the class, and again, he just got the newsletter and did the trade. I do think it is people really important for people. He sent me a picture of him and his wife. It's so sweet. But the point I'm trying to make is that regular people can do this. It's just that a lot of people don't know what to do. They're not trading the right stuff. They're not doing the right things. They're not doing things that move enough. They're not getting the right timing, and they're not getting the direction right. And particularly, again, in options, you can get the direction right, but if your timing is off, you're screwed. You're going to lose. You're going to lose if the timing is off. So it's important to get the whole shebang together. It's all about the gap for me, but it's really about institutional money, and it's institutional money in gaps. There is only one thing and one thing only that can move the direction of a stock. It's money, not a little bit of money, but a lot of money, or what I call power money. Power money is in charge. Power money is in charge of the stock's direction, and trends are set and moved by the power money people, of which there's a lot of in the market. And again, these are big funds. These are hedge funds. How am I going to know what they're going to do? I'm not until I see the gap. When I see the gap, then I'm looking at it, then I'm reading it. Okay, you don't know until it happens. But once it happens, then you've got the information on your chart, because again, price information is right there, and it's all the same for any of us. Wherever the market's trading right now, we all got the same number. We can see it. It's up or down, whatever it is. It's not something that's debatable. Okay, you can say, well, it's my opinion that the market's higher. It's my opinion the market's lower. That's all whatever. You have to make money right now, today, right now, this week, right now. How are you going to do that? You got to play the move. You got to play momentum. You got to get in. You got to get out. You got to book it, particularly in this put time right now where it's volatile. And again, your opinion doesn't mean much if you can't base it on something that's happened based on the price action, because that is all that matters. If you're a long-term investor where you want to be in something forever and ever and ever, that's fine. You love Apple as a company, you want to go long it when it falls off a cliff, fine. But how do you know it's not going to fall off a cliff again while you're in it long? Are you going to be able to suffer the pain until it goes back up and down and makes another new high? Could be a year from now, could be 6 months from now, could be 2 years from now. Nobody knows. You'll suffer then down in your position until it goes. So, I mean, again, people right now are going long, falling nice. I said that last week when I was on the hit on Ameritrade. It's kind of crazy, but that's what people are doing. Why? Because people think, oh, the market can't go any lower. Can't go any lower, they say to themselves. We've been falling all year. 9 months we've been falling. We can't go any lower. Really? We could go back down to the COVID lows. Don't think we can't. And even if we did, guess what? A lot of people are still going to be at money in their 401ks because the market had a huge rally 2016, 2017, 2018, 2019, and even in 2020. So even before COVID, the market had 4 years of a massive rally, and even before that, since the bank bailouts back from 2009. So the reality is that people think we can't keep going lower, but we can. We can keep going higher, that's true, but there's no indication of that right now, all right? So let's get back to gaps. Gaps happen in the market on a regular basis. What do I mean? I mean every single day. However, some gaps are better than others. Some gaps are nothing gaps, and some gaps are very powerful displays of institutional money. The most important gaps in the market are gaps that signify a change in direction or a bigger move in the same direction. Understanding which gaps are meaningful and which gaps are not meaningful in the market will help you to know what to do and when a change is occurring. That is how you know when the power money will go with you. That is how you're going to know where it is, how to spot it, how to see it. And again, this is very, very important. So far we've been talking about options. Let's talk about a couple day trades here. This is JWN, okay? Entry here short, we did the JWN. This was back on 8/24, 1935. 3,000 shares, which was 28.50. We made a little bit in this. Tried to squeeze $1 over it, couldn't get a buck. Got a good enough mood, 1868, profit 2010. It did continue. I just want to show this here. Again, this was Nordstrom. Stock closed here, gap down. This was earnings. Rallied, we shorted it, got the drop. Did come down, did end up breaking 19, and then fell. So again, this was on August 24th. This was a day trade. You would have taken this trade if you'd done it in the live room with me on margin. Okay, it is a day trade on margin. We did not do an option in this. But again, it fell and it continued after the fact, okay? Here is the setup. Again, this is a 1-minute chart. So I'm picking the gap and rating the gap on the daily, but then I'm taking the entry decisions on what? The 1 minute. Stock closed here, gap down, open, rallied, boom, we got it. One after it, this is a 1-minute chart. We shorted it, got the drop, ow. Again, it continued down a little bit more, and then it fell for the next couple of days. But we were in and out of this super duper quick. And when I'm doing day trades, again, I'm trading the gap in the 1 minute. I want to get in and want to get out as fast as I can, particularly because I want to be done early in the morning. If you're in options, you can be in options during the day. You could be in options overnight. And again, in an option, there's essentially no stop because the stop is what you risk. Whereas with something like this, I do have a stop and it's a hard stop. It's a limit order stop. If I stop in it, I get stopped out, okay? That was another gap. It was based on the rating system. It's a foundation. The gap itself is a foundation. I have a strategy that I use to trade every day. I apply it. I apply the system daily. If it rates good, we do it. If we don't have anything, we don't do it. So you need a foundation to trade. You need an infrastructure for every entry, and it's the strategy. Okay, it's the rating system. It's the gap itself. The strategy is the core reason behind why you're even watching the stock in the first place, or even contemplating an entry or trade in it. An entry in a stock should not be taken unless the trade has a foundation supporting it. It's very important. And the foundation for me is gaps. If you're a trend trader this year, you're most likely losing. 2022 has been a difficult year for many retail traders simply because they lack a strategy to use effectively on a daily basis in the market. And again, because 2021 was so bullish and people made money really virtually not even having to think, people now are getting hurt this year. People that bought dips last year are buying dips this year. It's not working, okay? Personally, buying dips is not a strategy. Why? Because you don't want to buy the dip and support. Why? How? I mean, there's a million supports, just like there's a million resistance. You don't know what one's going to hold. You have no idea, okay? So gaps are a strategy or foundation for the reason why you're taking the trade. When you choose to take a trade, there has to be a support system behind why you're taking it. 50-50 is not good odds, okay? And a lot of people are doing that this year. They're basically taking pot shots. The reason you're choosing to enter a stock or foundation for your entries should be focused on the quality of the gap. For me, it's the rating system. That's the support system, why I would enter a position. So again, a stock gaps when the opening price today is different from the closing price of the previous day's trading. The market will gap tomorrow. Where? I don't know. I don't know. But anyways, a gap is a break in the price action from one day to the next. Sherry's saying I have 5 more minutes here. Here's what I'm going to do. I'm going to skip ahead. I'm going to skip ahead and just show you one more day trade, and then I'm going to show you the information at the end if you want to get in touch with me. So thanks, Sherry. I wasn't looking at the clock. We did a day trade in Marvell. This was this particular day, 8:26. This was a short. See the big fat bar? Again, momentum. See the fat bar in there? Okay. Here was the 1 minute on Marvell. Again, I run a live day trading room, which if you would like a trial of the trading room, email me at melissa@thestockswoosh.com. We shorted it, got the drop. This was on 8:26 Marvell. So again, I'm focusing on gaps, I'm focusing on shorts. And if you'd like a trial of the room, you can email me. We also shorted the SPY. We shorted the SPY on 9/1 here. And this again is the 1 minute where we got the drop in that. But the whole point I want to make here today, the whole point I want to make is that it's having a daily focus, getting a daily focus. The 50-50 mindset is just not good enough. It's not good enough because trading is too competitive. You're going to lose if that's your mindset. So if you're interested in anything that I said today, I know I'm rushing you here at the end, but I'd certainly be happy to have you on a trial if you'd like to come to trial. Every day, though, I'm looking for stocks to have that have a high probability of directional bias for the entire day, big moves on the day, early confirmation of the bias in the move between 9:30 and 10, and precise entries with follow through and a good risk to reward. So my whole system is based on a 26-point checklist. It's a rating system where I go through each morning. If the checklist gets the points where it rates 20 points or more, I'm taking it in the direction of the gap. A checklist is a plan of action, and everyone that puts money in the market should have a plan of action or a checklist. The reason that you can make such large profits using the system is because you get the momentum, and again, volatility creates the momentum, which is good as long as you get it on the right side. But the whole basis for it is because they're so profitable, because we're following large institutional money. There is bullish institutional money. I have a couple bullish charts in here. Ulta was one. CVS was another, and bearish institutional money. Again, we've been doing many different stocks. Dell was a bearish chart, Marvell, which I just talked about. But ultimately, I think it's very important for people not to waste their time. People take pot shots trading, they waste money, they waste time, they take classes where they don't learn anything, and then 5-10 years of their life goes by and they don't really get anywhere with trading. If you're really serious about doing it and you want to learn, people are doing extremely well with me. If you'd like to come on board, the class is October 1st and 2nd. It teaches you the 26-point checklist, what to look out for every day, teaches you the entries and the exits. So again, if you'd like more information on the class or the system, it's called the Golden Gap course. It's a full 2-day course on how to strategically find, pick, and play stocks that are professional bearish gaps. Class is October 1st and 2nd. Class tuition is $69.99. Class is online. You can be anywhere in the world and take it. And I'm doing a webinar special starting today through Sunday, the 25th. If you want to join, because you're here, it's through Sunday. If you want to sign up, and the class will be the 1st and the 2nd. The tuition is the same as always, but you would get the trading room, the options newsletter free to the end of this year. So it's a nice special because you get all the trades to the end of the year, and earnings season starts in October. The combo includes the trends course too. Let me just take this off for 1 second before I give it back to the next person, Sherry, and just take a look here for everybody and see what the market is doing. I don't know if I can take that off and do it. I'm going to try. I don't know if this is going to work. Let's see. It may not work because I don't know how to do it. Stop screen sharing. Let's see. Oh, oh my gosh. I'm missing all this. Okay. Can you see the screen now?
Yes.
Oh, look at this.
You have 6 charts up.
Yeah, I'll just before I go, before the next person talks, I'm just going to give my 2 cents here. So anyways, I guess he didn't raise rates 1 point. I was thinking he might, and my take was that we might have a positive reaction. Well, none of that played out. We didn't have a positive reaction. He didn't raise rates 1 point, so clearly the market didn't like that. The market's worried that we're going to go into a recession. Yeah, so good luck, everyone. Be very, very, very careful here tomorrow on Friday if you trade, okay?
There you go.
Thank you.
As always, thank you so much. And I apologize for having to cut you short, guys and girls. Go to, you got to email Melissa to get the deal. It's, let's see, I'm going to send it to the entire audience. There it is. Is there a link? They just need to email you. Just email me, Melissa says. All right, guys. So let's see. Let me change some things around here. And thank you for being with us, Melissa. I really appreciate it. Okay. All right. Show my screen. All right. You should be able to see my screen. It's showing you Melissa Armo of the Stock Swoosh just wrapped up. And now we're going to bring in Mr. Ross Givens of the Stock Surge Daily. He's talking about the timeless breakout trade setup. I did a little bit of research on Mr. Ross because he is coming to Traders Exclusive Live Strategy Series for the first time. Thank you so much for joining us, sir. The bio that I have found for Ross, one of the things I really noticed was a quote from himself where he bought his first stock when he was 12 years old. It was Microsoft. And I thought it was really interesting, and I think you guys will too. The only thing he enjoys more than making money is helping you make money. So clearly he got the trading bug at an early age, and he bought his first stock at 12 years old, 100 shares of Microsoft. Please, when I give this over, tell us if you still have it. After earning a degree in finance, he quickly learned the ins and outs of the investment business as a broker, financial advisor, and professional money manager. He even served as a vice president for a major investment bank, and he held Series 7, Series 66, and Series 3 securities licenses. And Ross has a simple investment philosophy: follow the money. So he's dedicated many years to studying volume patterns that reveal pending moves in under the radar stocks. Welcome, Ross. Thank you so much for joining us.
Hey, thanks for having me on.
And I'm going to, now, do you like to chit chat and have people interact?
Yeah, turn it on. Let them talk to me.
All right, I'm gonna turn it on.
Come on. Y'all tell me whatever, ask me whatever you want.
Yes. And then I'm gonna make you the presenter. Yes. And now you should be able to take it away.
Okay. Whoops. It's freezing up on me. All right, I was trying to turn my my webcam on. I've got 4 of them. Whoops, now it's freezing up on me.
We'll get every angle, right?
I guess it's freezing me up here. They're built into the monitors. Anyway, let me well, this whole thing's freezing up on me. Sherry, give me 2 seconds. I got to close this and reopen it.
Right. All right, let's see. He's going to come right back in and we'll get started. And he's in. And I will
All right,
make
sorry
him.
about that. This Mac does not like GoTo, so it always wants to freeze up on me. But let me see if I can take over the presentation here. 1 second. You're just twirling and twirling for me.
I love it when it does that.
Mm-hmm. There we go. Let's see. All right. Now, you guys should be seeing my screen there. If you do see some charts, just give me a yes or a Y. Something there, let me know you see it. Perfect, Judy. Thank you very much. All right. So today, listen, I'm not going to do anything super formal today. I heard a couple of things in the last presentation that I'm going to have to disagree with, but that's, everyone has a different stroke to it. One of those being that a 50-50 trade result is bad. And I'm going to show you today what you want to focus on is how much you make when you're right, and how much you lose when you're wrong. And they're professional traders. They're multi-billion-dollar hedge fund managers who are not right half the time. They cut those losses very, very short. And so what I'm going to share with you today is this work is actually based on research from a guy named Richard Wyckoff. And this goes all the way back to the 1930s. And a lot of people don't realize this, but stocks move in a fairly predictable and repeatable pattern, at least for growth stocks. You can go back and look at charts of Apple and Amazon and Google, and this is Roku, Netflix, Crocs, whatever you want. You'll see this same 4-stage pattern, this cycle the stocks go through. And this is from May 2020 up to today. So about 2 years here. So a stock like Apple may take 5 or 6 years to go through this. A stock may do this in a year and a half, and it's repeated over and over again. And most people don't realize this, but it's crucial to understand. You don't need to memorize this screen. You may want to screenshot this, but just to understand where a stock is in its life cycle, because trading is all about putting the odds in our favor, right? If you're buying in stage 2 in that green box, there wasn't really a bad place to buy, was there? The trend of the market is sort of bailing you out, the stock's being supported, versus stage 4, there really was not a good place to buy in there. So just kind of walk through these. And again, every stock was the same process. The first stage, the accumulation stage, generally the stock's just trading sideways. It's chopping back and forth. This would be like stocks today are called value stocks and things that are just, trading at 15, 16 times earnings. Nothing exciting, nothing terrible, just kind of going sideways. And generally, big institutions will be building positions here. Stage 2 is the markup phase. This is where things really get interesting. This is the only place I buy stocks. I don't bottom fish. I don't look for anything. I don't buy falling knives. I don't do any of that crap. I'm just looking for stocks that are trending higher. Now in stage 2, generally some positive news has come out about this company. Maybe they're growing earnings at a great rate. If it's Apple, maybe they just came out with AirPods or some new product that's selling really well for 2020 for Zoom and for Peloton. It was, all of a sudden everyone's stuck at home buying these bikes and going to meetings online. There's some catalyst either with that business, with that industry driving it up, and demand is increasing for that stock. Remember, stock prices move on supply and demand. It is no different than stuff on eBay or used cars. If a lot of people want it and demand is high and you have more buyers and sellers, it's going to go up. If supply is higher than demand, meaning more people want to sell it than buy it, it's going to go down. So we simply want to be in the demand phase. Now, stage 3 is distribution, and this is where most traders screw up. Big institutions have built positions. In this case, maybe an $80, $100, $120 bought all the way up. Well, anyone who's worth their salt knows a profit is not a profit until you sell and take it. So eventually they've got to do that. They build positions in this stock. They plan to hold for months or maybe years until it hits what they believe is a fair value or something well in excess of that value. Eventually sell. Now, what you'll notice about institutions is they buy fairly slowly. So take someone like Buffett. It's taken him months, probably all year, to build his position in Occidental Petroleum, but generally they'll take weeks and months to build it. When they're ready to sell, they just hammer the sell button and dump it. They fire sale it. And so stage 3 is your early warning. Institutions are getting out. And I said this is where most traders screw up, because what most traders do, what do they do in here? BTD, right? They buy the dip. 2020 taught a lot of new investors some really bad rules, and the main one being all stocks go up and buy the dip. And they've learned the hard way this year that some stocks simply keep on dipping. Everybody agree with that? So you'll notice stage 3, by a change in character of the stock, it just basically makes a big move down suddenly, and usually on big volume. So notice how smooth the stock is riding up in stage 2, and then look at this. Boom, down 15% in 1 week, down 10% the next. I mean, this stock goes from a nice smooth glide several 100% higher to shedding, 30% of its value in 10, 14 days. Stocks that are being accumulated in mass, like in stage 2, that are being bought by institutions or private stock, do not fall 30% in 2 weeks. That's your early warning. And so people buy the dip, and sometimes it bounces, sometimes it doesn't. But that's simply your early warning. The party is over for Roku, and the stock has proceeded to fall 85%. Now, if you're one of those bottom fishers, you're a value investor, going, I like to buy stuff when it's cheap, I would caution you against that. I say that as a reformed value investor. I've read everything Buffett and Graham and those guys have put on paper in the last 70 years. But look, here's the thing. Your friend buys it up here at $4.50 a share. You buy it at $2.25. You get it. You say, oh, you moron. I got it at half the price you did. I'm going to make so much money. Well, fast forward to today. Your friend is down 84%. You were down 70%. So do you call your friend and brag and say, you moron, you're 84%. I, an intellectual, a market savvy participant, is only down 70%. No, of course not. You're both out on the street with a cup in your hand. So I tell you this just to say you only want to buy stocks that are in stage 2. Does that make sense to everybody? Judy, how are you? It's been a while. Everybody understand that? Stephanie, Maverick, I know you guys are awake in here. Judy, thank you. All right. So we understand in stage 2. So now we know what we're looking for, right? We're looking for stocks trending higher. The 200-day moving average is pointing up. The 50 days up. It's above that. What is the setup? How do we get really precise with that and buy the stock at the point where it's the greatest possible chance of making a rapid run higher, and do so with very little risk? And by the way, for any of you, I know these webinars go, if you're sitting there going, oh, what's he going to sell us at the end? I'll go ahead and tell you it's $5. I'm going to give you an annual subscription for $5. So don't be scared that I'm buttering you up. I don't have a $7,000 course to sell you or anything. Okay. So let's look at how some of these work. So let's look at the breakout. Let's take a stock like DFIN. These are recommendations I made in my stealth trade service. What I'm doing for $5, I'll tell you about. And here's what I want to look at. Is this move here. And this is sort of a textbook one. They're not all this perfect, but it's better to win on like a textbook example so you know what you're looking for versus a bad one, all right? So clearly this stock was in stage 2, right? Just grinding higher, moving averages are pointing up, it's riding its 50. We know it's in stage 2. The question becomes, when do we buy? How do we buy and not just sit there and hold it? How do we buy right there? Right as it's breaking out, we're profitable on day 1, makes a rapid run higher. We get up 30, 40% in a month, or several 100% if you're trading options or whatever. How do we do that? Well, this is the setup we want to see. This is kind of the bread and butter setup. I call the stealth trade setup. And again, I'm not taking credit for all this work. Everything I know here, I've learned from U.S. investing champions and books and other people who've done this for hundreds of years. Anybody who comes and tells you, I've got this proprietary system with red dots and green arrows, it is what it is. But this is the setup we want to see. We want to see the stock make a rapid run higher and then pull back in a series of these shallowing retracements from left to right. You'll notice how that happens. And if we measure all these out, first the stock pulls back 29%, then it pulls back, 14%, then it pulls back something like 7%, and it gets really tight, like a 3 or 4% range over here. So why do we want to see this? Why is this telling us? And by the way, you obviously buy when it breaks above the resistance, above that white line. We want to get in right here. But why do we want to see this? Why do we want to see this compression happening here in the chart? Well, what you're seeing is a visual representation of supply and demand playing out in the stock chart. So stocks don't just go straight up, right? We all agree with that. How many times you bought a stock and just did this? Never. They do this, right? Why is that? Why does it pull back if it's so good over and over? Well, simple. We talked about it earlier. If there's more buyers, if there's more demand, it's going to go up. There's more supply or sellers going to go down. When a stock makes a big rise, what do? You bought this stock at $13. A few months later, it's at $35. You're up 150% in 6 months. What would you do? What would you do here? Bill, Bob, Craig, Diane, Frank, I'm calling you all out. Ian, Jim, Joe, what would you do? You're up 150% in 6 months on a stock you bought. Mike? Frank says sell. Thank you, Frank. Frank says sell. Yeah, I would sell half, Maverick says. I would agree. And most people are going to do the same thing. Maybe you sell half, maybe you sell a third, maybe you sell most of it. There's no right or wrong answer, but we all do the same thing. And it's everyone from us to the people managing billions at Fidelity and Schwab. So to book some profits, they sell, and that short-term supply or selling causes the pullback. Now, if the stock is still in demand, if it's still being accumulated by big funds, big institutions, they should take advantage of that and push the stock back up. At which point, you may get another pullback. Well, guys saying, man, I should have sold it at 34. It fell all the way to 25. If it gets back there again, I'm going to sell it. They do, and it pulls back again. Now, the second pullback is shallower, isn't it? Why is that? There's fewer people. A bunch of them sold back here. So again, if it's under accumulation, it's being bought, the stock should push back to its highs, pull back again, a little shallower, still being bought back up. And this is super, super shallow. I like to see volume even dry up and decline on these pullbacks because you want to see more volume on the pushes higher and lower volume on the way back. What you're seeing is simply supply and demand play out. I like to visualize this. I like to picture this stock back in a day when we had paper stock certificates, right? And I like to picture maybe 1,000 people, 10,000 people standing on the front steps of New York Stock Exchange. When I want to sell my shares, I've got them. They're 35, they're 34 half, whatever. People come, a bunch of people buy them up. The next day, there's maybe 700 people up there. The next day, there's 200 or 300 people up there. And there's 50 and 20. And one day you go and there's like 2 guys selling stock. You've worked through that supply of the tens of thousands or millions or whatever shares people want to sell at $35, $36, $37. You got to get through that supply. You want to work through those selling orders until you get to a point where no one's selling anymore. The stock's not pulling back. Supply is not coming to market. The stock's becoming harder to buy. That tells you you've worked through all the supply. So instead of holding up to here and going, ooh, that hurt. Okay, we're back. Ooh, not fun. Okay, thank God, get me out of break even. You can sidestep the whole thing by allowing this to play out and simply wait until it gets above here to buy, if you buy at all. If it gets up here and it fails, you don't own it. This is extremely beneficial in a bear market like now because stocks aren't breaking out, so we're not buying them. I don't want to own stocks right now. We got a couple every once in a while, but not near as many as we usually do. And so once you've worked through that supply, it breaks through resistance. It's shown you now all the sellers are gone. That's when you hit the path of least resistance and the stock is free to make a rise higher. Notice when you get a small increase in demand, the stock makes this huge move because it's not fighting supply, right? Think about it like the housing market, 2020, 2021, prices went crazy. Why? Well, for one thing, they locked us in our houses for 6 months and everyone realized I don't like my kitchen. I wish I had a pool. I'm going to move. And then there just wasn't much supply when houses were for sale. So you had an increase in demand. You had very little supply and prices rose. Well, now the prices went way up. Everyone wants to sell and cash out. You get a bunch of supply dumped. And now interest rates are at 6% instead of 3%. So there's no demand. Nobody wants to buy a house because mortgages cost too much and prices are coming down. So that's how this works. And it's just kind of a top-down approach. We're looking to identify stocks that are in stage 2. We have all the odds stacked in our favor. And then we're looking for this setup where we see the retracement shallowing and shallowing and shallowing, and preferably volume drying up in there as well. I'll show you another. All these are trade recommendations I sent out in my service. Some are bigger than others. Right, I'll show you another one in phase, but same thing here. This is the Andersons. Look at it, clearly running in stage 2, pulls back, holds, and look at this, shallowing, shallowing, shallowing. Had some big volume in here on the rise up and then dries up right here to the breakout. See how low it got right there? And then boom, you buy, whoops. You buy above the resistance when it breaks through right in there. In the stock very rapidly. This one wasn't a huge one. This one actually went into another base here. From 31 to 38 in, what was it, a week and a half or so. And then look, it does the same thing again. Same format, shallowing, shallowing, little head fake, shallowing, breakout, push higher. Now, let me tell you the other benefit of this. Again, I told you in the beginning, I don't like people say 50-50 is terrible odds. I know professional traders who are right 30% of the time, who make millions of dollars. So don't be confused by these people who say, I win 80% of the time. Well, that's nice. How much do you lose in that 20%? And if people are out here risking 25, 30, 40%, 50%, no stops at all, they're not going to last very long. And so what you always want to focus on is getting odds on your money. How much are you risking to make whatever you're going to make? So a day trader may risk 1% to try to make 2%. A swing trader like me may risk 6 or 7% to try to make 20 or 25. A long-term investor may risk 15 or 20 to try to make 70 or 80. But if you're risking, 15, 20, 30% and taking profits and you're up 5 or 6, you're gonna be in a poorhouse real quick. So this is what I say, why I like this. Another reason I like this approach is it allows you to keep risk very, very small. All right, let me show you a different one. Let's go back to defend. So we're on the same example. So let me just trace this, what's happened here, what we've been talking about, right? It goes up, back, up, back, up, shallower, 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 off to the races, right? So notice how each one of these pullbacks, it did not go back below. We talked about it gets shallower because there's fewer sellers, right? A little higher. It's just higher lows, right? Nothing groundbreaking here. So it tells me once this low is put in, it returns back to the high, it should not go past this again. It should not go back below this. It should not go back below this, right? So the added benefit of allowing price to get very tight, as I say, and getting pullbacks very shallow is your risk shrinks every single time. So I'm going to use the white lines where we would buy. I'm going to use this red line to represent a stop loss. We're all familiar with stop losses, right? If it hits there, sell it. I was wrong. Okay, so let's say it ran up and broke out right here. Where would you want to put your stop? You'd want it below the last swing low because it shouldn't go below there. So in this case, that would have been 31% lower, too much for me to risk, okay? It runs up, it pulls back again, it goes back higher. All right, say, all right, well, if it breaks out from here, if it broke out right there, where do I want my stop? Well, below the last little swing low. In this case, that'd have been about 17% risk, still way too much for me, way too much. Okay, it pulls back, goes up. What if it broke out here? Well, I want my stop, again, last swing low, which in this case, right back here at about 14%. Better, but we're still not there. Each time it retraces, that the last swing low is your stop loss, or where you want to put your stop loss anyway. Now we're down to about 10%. We're getting there. I need to be at single digits. I'm not about blowing up. I'm about risking a little to make a lot. So here we are. Here was the trade. It finally breaks out. There's your stop loss, 4.83% below where you bought it. Now, would it be great if the stock ran 100%? Absolutely. What if it only ran 10 or 12, 13, let's say it ran 12%, you sold it. Well, you still made 2.5 times what you risked. Now, if you played this one perfectly, which you never will, you made 45%. So you risked 4.5 to make 45, or 10 to 1. In reality, you probably would have sold it, what, somewhere in here, maybe back here, and it broke down below the 21 day. Let's be realistic about this. So let's say you make 20, 22%. That's still 4 to 5 times what you risked on the trade. And that is the big secret to success and what champion traders do. They're always going into every trade risk first. If I saw this same setup, a great stock I really want to buy, but the last pullback was 17% below the price, I'm not going to take it. I'm not willing to risk 17%. I'm just not. Guess what? There's over 6,000 stocks to choose from. Find another one. Who cares what Facebook and Apple and Google and FedEx are doing? There are millions of people studying those same stocks. How many folks come to you and talk about Donnelley Financial? How many talk to you about Anderson's? How many people in here traded Deswell Industries? I did. I bought Deswell in my account and with my members right here, and I sold it half here and half here. I'm not going to sit here and tell you I bought the low tick and sold the high tick. But where was my stop loss? About 6% below where I bought, the last swing low, right in here. And the stock quickly advanced in 4 or 5 days, 16, 17%, up to 32%. 30% in 2.5 weeks when you're risking 6 is very, very good. And the secret to big wins in the market is not, oh, look at this 700% winner I had. It's compounding the smaller winners and keeping that risk low. It's putting one after the other and using the power of compounding. I want to be in cash as much as possible. I only want to be in a stock when it's moving, and I want to be out as quickly as I can, risk finance, profits nailed down back in my pocket. I have no interest in buying this stock back here, watching it fall 20% and get back and 10 and this while I'm biting my fingernails for 4 months, hoping to God it comes back to break even. Then what are you going to do? You're going to sell as soon as you show any profit because you're so tired of suffering. How different is it if you bought here on that candle and within 24 hours you got a green number in your account? The next day you're up. Next day you're up 8%. Goes another 3% the next day, another 3% the next day. So you're up 15, 20% on the stock in the first week. How much easier is it to manage a trade when you're profitable from day 1 or day 2? And look, you're going to get some wrong. I get stopped out, make plenty of wrong trades. But I never risk more than about 8 or 9%. And generally, I like to keep that about 4 or 5%. And I don't have to, because I'm not guessing what the stock's going to do. I'm saying, all right, based on history, based on the best performing stocks of 100 years, based on the law of supply and demand, a setup we see, it looks like this stock is being accumulated in mass by large funds. I'm seeing the footprints of institutional buying. I'm seeing supply run out of the market. It should break higher when it gets above here. If it does, great. If it doesn't, okay, I'll take my 5% loss and go to the next one. And why I really wanted to harp on that 50-50's bad odds, which I 1,000% disagree with, is like you want to price in failure. Okay, if you're buying stocks or buying breakouts, for example, I'll be the first to admit they don't work as well in a bear market they do in a bull market. People love to come in here and go, we're making all this money this year. Then you're going to get pounded when it's a good market. I promise you that. No single strategy is going to work 365 days a year in every single market environment. It's just not, right? Breakout traders like myself are seeing a lower win rate right now. Value investors are getting probably pummeled. Anyone who owning growth and just using no stop losses is going into retirement right now. People who sell options are probably doing pretty well because premiums are so high. There's a time and a place for everything. But when I'm risking very, very little, like I said, pricing in failure, if my average loss on a trade is 5% and my average gain is 15%, what does that mean? It means I can lose 3 out of 4 trades and still be break even. If I'm right 50-50, I'm going to make a lot of money. You see how that works? You want to price in failure because look, in a bear market, a nasty volatile market like this, your win rate's going to be lower. But if you're risking 5, let's just say risking 5% to make 10%, okay? That's all you're doing. The biggest win, average is 10%, average loses 5%. You can still be wrong 65% of the time and make money. So you want a strategy where, hey, in a good market, things are really working out. I'm right 7, 8 out of 10 times, I'll make a fortune. In an okay market, I'm right 50-50, I'm going to make a little bit of money. In a terrible market like this, where I'm wrong 3 out of 4 times, 3 out of 5 times, I'm going to just barely make a little or break even or just barely lose a little. That's the secret, and that's what everyone misses. But it all comes down to a simple approach, a strategy that is proven, and this has been used by some of the best stock traders in history. Everyone from Jesse Livermore to Paul Tudor Jones to Dan Zanger used a similar approach. I mean, use chart patterns and all, but a similar, Can Slim Minervini type approach that he used to turn around 11 grand into $18 million in 2 years. I'm not saying this is a strategy. I don't know. I'm not taking credit for it, but I know the approach he takes, and it's all very similar. This is not some new red light, green light system that was cooked up. This is a seasoned approach based on supply and demand dynamics, and how institutions move in and out of the market. So I'll show you a couple more trades. I'll tell you about the thing. If you want to join me, fine. It's $5. If not, that's fine too. You're not going to hurt my feelings either way. This is In Phase Energy. This is a trade we took. In fact, we just bought more of the other day on a little pullback. But this was the trade we took, issued in one of my services earlier this year. And we bought. And when I say this, I'm not going, look how smart I am. I bought here. I'm just telling you, like, I put my money where my mouth is, right? This is what we do. This is In Phase. So two things about this one. First of all, this is a market leading stock in a market leading sector. Right now, we are in a stock pickers market. This is not where just get anything, they all go up. The beginning of this year, everything got hammered except for what? Energy, oil, fertilizers, marine shipping stocks. Those finally rolled over. Now, right now, the strongest groups, biotech, health stocks, solar, alternative energy, that's what's pushing right now. And in fact, Investors Business Daily ranks every single sector by relative strength. So you just pull up a list of all 197 and see what are the top 10 or 20 areas. And right, solar's been number one for several months. So solar's the best sector. Okay, what are the top stocks in the solar space? Well, it's In Phase, it's Sunrun, it's First Solar, it's Canadian Solar, it's a handful of others. So if you get the opportunity, you get a leading stock in the number one leading group setting up in this pattern. That's when you start to your mouth starts to water, right? That's when you start to wet your beak there. But it's no different than anything else we've looked at. Same thing, in stage 2 uptrend, shallowing, little shallowing, and then right there, just super shallow. We bought right here, I guess 1, 2, 3 days before the big earnings breakout there. And the stock jumped. I mean, it went up, 40% in 2 weeks, and now it's trying to come out again. Another one that was just absolutely textbook. Again, a stock we bought in the middle of this bear market was Permian Basin Trust. I mean, this one just couldn't be any prettier. It's just so perfect. And by the way, let me look at this go, hey, I went back down. Well, I don't care. I sold it long before. I sold it long before it came back down. I'm nailing in profits when it goes up. But I mean, this just couldn't be any more perfect. It's just a clean up trend, little shakeout move here, and then just shallowing right into that base. Big volume on the breakout, creeps out that day. We got it at $14.10, I think, 14, something like that, and just blast off. I mean, this bad boy ran 58% in 21 days, in 3 weeks. You catch half this, catch a third of this. And again, what were you risking? We risked 7.5% because our stop loss was at the little swing low right here. The last little pullback is where we put our stop loss. So you look at this big chart. All right, where do you want to buy this one? Anywhere on the chart, where would you want to buy it? Right where we bought it. Literally, you couldn't buy it any better than that. You can do this, is what I'm telling you. You could have bought it here and had the same results. But what do you want to do? Do you want to hold it for 6 months on dead money before it finally goes? Or do you want to buy it when it's coming out? I like to use the analogy of, like, if you're going on a road trip, you're not, somebody else is driving. They're picking up you and maybe 2 other coworkers. Like, all right, I got to go get Melissa. I got to get Jerome. I'm going to stop, fill up his gas, fill some snacks. Do you want them to pick you up first and run all around town and back and forth and get your car sick until finally, good Lord Almighty, we're finally on the road? Or do you want to say, you know what? My house is by the interstate. Why don't you just pick me up here on the way out of town? I want to be picked up on the way out of town. I have no interest in running errands. And so that's what we do. Questions about this? Y'all are pretty quiet in here. Talk about anything you want. I got no script. All right, we'll tell you what, Sherry, if you would, I'll put in a couple minutes early and get you back on track here. If you put that link in there, I run a service, guys, called Stealth Trades. What we do, is I educate on this every single week, every single Monday at noon Central, so 1 o'clock Eastern. I hold a live Zoom session with my Stealth members, and I do just what I've been doing with you here. We go over the process. I give you 3 of my top stock picks for that week, where I buy them, where I'd sell them. Answer any questions you've got. We look at the overall market, and that's like everything from the up-down volume ratios, the internals and net highs, and all kinds of crap we don't need to waste your time with right there. And then we do this live every Monday. They're free to attend. I also send out like 1 or 2 official recommendations per month. Just send it right to your SMS, to your phone. And he has $5 for the year. There's no catch. We literally lose money on this. It costs us more in support and software and stuff like that. But, look, we do this because we hope you like it and you want to do more stuff with us in the future. If you do, great. If not, that's okay too. You're not going to find a better deal. If you don't want to spend $5, then probably don't want to be trading. Diane, what indicators do I use to find these trades? No really indicators to find them. I mean, all I'm looking at on a chart is price, moving averages, volume, and relative strength. Like, that's it. I do use a scanner. I use MarketSmith as my scanner. You can use anything. I like this one a lot. It's from Investors Business Daily because I can scan for literally anything. You can scan for, typically I'm scanning for the characteristics of the best performing stocks for the last 100 years. And so those are things like 96% of them have started after a bear market. 96% began above their 50-day moving average. 99% were above their 200. More than 90% of them had increasing earnings growth the last 3 quarters. So you want to see big earnings growth, big sales growth, high relative strength, just meaning the stock is outperforming other stocks. So like Consolidated Water, see the relative strength rating of 98. That just means relative to stocks, it ranks in the 98th percentile. So it's outperforming 98% of other stocks in the market. And generally speaking, you want the best of the best. Like I said, there's 6,000 stocks. Why are you gonna settle for crap? Oh, this one, yeah, it's down 80%, but it could make a turn. Well, why are you gonna risk your money on that when there's stocks that are ripping higher? If you're buying stocks, you want the best of the best. If you're shorting stocks, then go take a look at Facebook and Amazon, the other turds sitting on the float at the bottom of the market right now. But if you're looking to buy stocks, you want the best. And so that's how I scan. And then I literally just go through anywhere from 500 to 800 stock charts every weekend. Find the setups I like best, generally based on the top groups in the market, the highest relative strength, and then the best technical setups. And we look for those low risk entry opportunities. Thanks, Ross. I have IBD as well. Look for strength in the market. Oh, perfect. You get it, Judy. Vince, are you concerned with volume being low? Yeah. So Deswell, that's a good question, Vince. Deswell, I probably shouldn't have taken. It's a really low volume stock. It trades like 20, 30,000 shares. Generally, I want to see at least 100,000, preferably 300,000 shares in average daily trading volume. So like DFIN, you see the average there around 180,000 shares a day. ANDE was around 150,000 shares traded per day. IDXX, another one we did, 400,000 shares trading in a day. And then a lot of the bigger caps going to be in the millions, obviously. So yeah, really good question, Vance. That's kind of where I filter it. You can still trade some of the thin ones, depending on your account size. Like if you've got I'd say if you're trading like 500,000 or more, you probably want to avoid those really thin, smaller stocks. You want stuff that's got enough volume to absorb your action, and you're not going to move the price, and you're not going to have a problem selling it and all that. But other than that, yeah, pretty straightforward. Let me see if I can type this link in here to you guys. Where is it? I had it somewhere. There it is.
I put it in there already.
Oh, you did? Perfect. All right.
Yeah.
Here's on top of it. All right. So yeah, the link there, by the way, if you go to that page, it looks like this. Got my ugly mug at the top of it here in a little video, but it just kind of goes over everything we do. And then there should be an order form. If the order form does not load, like it should load over there. See, it says don't see order form. Just click there. You just set up, and again, it's $5. It's for the entire year. You're not going to see a better. I don't know how to make it any cheaper than that for you. So,
Wow.
All right. If there's no other questions, Sherry, I'll turn it over, and you can get back on schedule.
I really appreciate that, Ross. You are right on the money with this. Oh, look, Maverick says, Ross always gives a great presentation. No filler, just clear, actionable information. That is a really good testimony. All right, I'm going to, I really appreciate you being with us. Ross,
Yeah,
I know you worked this out just for me, so thank you.
Yeah, not a problem. See where we're at here.
All
Let's
right,
see.
well, I hope you'll
All right,
come
y'all have a
back
good day.
again. You too, you have a great day, and thanks very much again. All right, folks, that was Ross Gibbons. And you really do need to take advantage. I mean, $5, come on. I am going to switch over to me as so you can see my screen. And that was Ross Gibbons of Stock Search Daily. He's given us a link though. His link goes to stealthmodeinvesting.com, and I'm not even kidding you. You probably want to do that. It's $5 for a whole year. It would totally it'd be a no-brainer, really. Cannot make enough quick notes. Can we get a replay? Yes, Dan, we are going to have a replay. It's at tradersexclusive.com/webinars. It's archived_webinars. But you will get an email from GoToWebinar, and you will get email from our presenters, and you will get an email from me. So with that said, I would like to introduce our final expert for the day. It's Rick Sadler of Hit and Run Candlesticks. He's going to bring us 9 pro tips, not trips. You got to make your own pro trip. He's going to talk to us about 9 pro tips to make swing trading simple. And I love it when he comes. He is always entertaining, and he always brings a fantastic presentation. And we'll get those links out for you, Paul. Matter of fact, I'll put that in our chat. Meanwhile, I'm going to promote Mr. Sadler so that he can give us his presentation. Are you there, Rick?
Excuse me, I am here, yes.
How are you today? And thank you for being with us.
Oh, I'm doing great, Sherry. Hey, can you hear me okay? I just moved the mic
Right as soon as you said that, the mic is gone.
there.
There we go. Make sure you
Okay.
got a good connection, because when you said, how do I sound, I just moved my mic. The mic was just gone.
Oh, okay. Hey, does this sound a little better right here?
It sounds good. Yep.
Okay. Well, we'll
And
leave
we
that
can
right
see
there.
your screen.
Let's see. Let me figure out how to share a screen.
You got it. Well, did you share your whole thing?
Nope. There. I just shared a
okay.
screen. Does that work?
Okay. Yeah. Now, if you have to switch screens, you'll have to do a reshare, but that's okay.
Okay. You can see the SPY, the chart right here.
I do.
Okay. This is always a challenge for me getting hooked up. I do apologize.
Because we're all
to
used to
everybody.
Zoom now.
Yeah.
Everybody's used to something other than GoToWebinar, but GoToWebinar just is really uniquely suited to this actual.
Yes, it is. Yes,
format.
you are very correct here. All right, Sherry, thank you so much.
You're very welcome.
I appreciate it. Hey, am I the last?
I didn't introduce you. Just a minute. Hold
okay.
on. Let's not get carried away. Rick is the founder of Hit and Run Candlesticks and Trading for Profits, or is it Hit and Run Candlesticks - Trading for Profits?
Hit Run
Both.
Candlesticks. Yeah.
Yeah. Okay.
Yeah.
Somebody added that for me. I don't know. We'll have to talk
No, that's
to
okay. The old
powers
name
that
used to
be.
be. Yeah, the old name used to be Hit Run Candlesticks Trading.
Oh, okay.
Yeah.
So he started trading in '88, reading books, following traders, and watching webinars. And I got a little chuckle out of this, although it probably shouldn't have. The first few years of trading were in education and losing money and seriously questioning his trading career. I'm pretty sure everybody does that.
Yeah.
But he learned a lot about trading over the years, obviously. And the idea is here that there are 9 pro tips. Why do I want to go on a trip so bad? There are 9 pro tips he wished someone would have told him about, but of course he probably wouldn't have listened. Like many new or struggling traders, he added more to the charts and created more confirmation. In truth, his trading really became better when the 9 trading tips were integrated into his trading. I can't wait to see the 9 tips. So thank you so much for being with us. And thank you for putting up with me messing up something. And you
Hey,
have, take it
no
away.
problem. Thank you, Sherry. You're the best. I love I love
Thank you.
working with you because it is so easy and you're kind. So thank you very much.
Oh, well, it helps
Thank
when
you,
you're cut.
Traders Exclusive, for having me here. It's not my first time, so anytime anyone invites me back, I think, all right, it must have worked. So thank you so very much. Thank you for everybody that's here. I truly appreciate it. I'm a question guy. I love questions, so please, please let them fly. I don't mind answering them on the fly. Sometimes they might be a little bit better toward the end, but I'm going to stay here as long as Sherry will allow me to stay here. So we're going to have plenty of time. So a great big welcome to everybody. For those that don't know, my name is Rick Sadler, and I am the founder of Hit Run Candlesticks. Today we're going to talk about 9 basic trading principles, plus we're going to look at some charts, because I'm going to get through these slides and then I would like to look at charts and take your questions. Unfortunately, here's the bad news, okay? And this is where a lot of people want to disappear, is I've got 16 slides. I'm going to fly through them. Not a single one of them have a chart on them. And I will explain why. Now, usually I don't do this. Usually I'm all about charts and just pull up the charts and I can talk till the day is long about a chart. But today I'm doing something a little different. And the reason is the market, the way it's been, shambles, if you ask me. Traders have lost a lot of money. And I take calls or emails every day. I do some kind of coaching, not necessarily every day, but 6-7 times a week, Monday through Friday. Special occasions I'll do on Saturdays. But one of the biggest problems is the 9 trading tips. That was just messing with you on that one, Sherry. 9 trading tips that I think are are just they are the foundation. Okay, so, and I apologize, I'm getting a little ahead of myself. We're going to have, a 30-day trial with Hit Run Candlesticks. I'll show you more about that at the end, maybe, if we have time. But some things that I really want to point out that I want to help with is, and this is just a couple of things that is involved with the 30-day trial. One-on-one private coaching, trade alerts sent through to your phone instantly. And this is something kind of new right here. And this is a trade logic video. So after we place, sometimes before we place a trade, within a minute after we place a trade, you receive an alert on your smartphone. And give me about 5 minutes and you will have a trade logic video. The trade logic video is usually about a minute and 30 seconds long. But anyway, all of this, and it will be part of the trial. Anyway, I better get going here, okay? So there we are. I need to do this really quick. Legal disclaimer, everybody read through this if you want to. I'm not gonna read it to you. It just, bottom line, it is that trading stocks, investing is extremely risky business, and you really need to have all your eggs in one basket when you do this. Never trade with your last dime. Don't try to, don't trade. Like I said, just read this and be very careful when you're trading. It is extremely risky. Okay. All right. Well, we already did this here. Oh, okay. This red thing reminded me. For those that want to become a member trial, it's member for 30 days, full membership. Something I'm going to do is we're going to cover everything we do with trading, like the entries, the type of charts. For those that have heard about the T-line, we'll be talking about that. The trend indicator, we'll be talking about that. Candlesticks, we'll be talking about the 3/8 trap entry, both bearish and bullish. We'll be talking about below the highest high in the past 5-day entry and a breakout, or above the lowest low in the past 5 days or breakdown entry. Those are my favorite entry. That's what this is right here, my 3 favorite entry setups. And I'll also will show you how to plan and trade in less than 1 minute. It is so easy to do and so doggone important to do. All of this, we will each, maybe not every single day of the 30 days, but what I will do with everything that's important that we do, I will record, I will set aside and record it in case you can't be in the trading room. I will record it and it will be sent to you. So you won't miss a thing and you'll get everything. So I understand you might not, maybe you can't be in the trading room, or you don't want to be in a trading room all day long in front of your computer. I get that. That's why we'll record that and get that sent to you, okay? So you won't miss out. All right, let's get down with these 9 basic principles. The clock is running, so I better get going here. There are 9 basic principles that I believe are the total, they're just so totally important. They're the absolute core to successful trading. Somebody can give you a trade that somebody makes money on, and you don't make money. How many times has that happened? And believe me, I know there should be a lot of hands being raised right now because I hear about it all the time. Well, I think the biggest reason is you just don't have that foundation. Because let's face it, we're human, and what we want to do is we want to go out there, just give me the stock that's gonna make the money. That's what we want. And I get it. That's what I want too. It truly is. But if you don't have the foundation and understand how a trade works, because trades just don't always go up, straight up, just because you look at it. They might go up a little, down a little, up a little bit more, 2 steps up, 1 step back kind of a thing. You keep doing that, it grows. Unfortunately, on that 1 step back, you bail, you get scared, whatever, you're out of it, and then it goes up and you're wondering what the heck just happened. Well, it's that foundation right there, okay? Price action, candlesticks, indicators, trend lines, and patterns are all a few other tools a trader will need. It's not just one simple tool. There are a handful of tools. These are things we will, without question, discuss and talk about starting Wednesday. Oh, do I have that on here? We'll get, yeah. Starting Wednesday the 28th, I think it is. We'll make sure that from that point on, we will take those subjects and make sure they're recorded so you don't miss out on it. Principle number 1. I think I could actually stop this presentation right here after we talk about principle number 1. I truly, truly believe that this right here is one of the biggest problems of most traders that don't make money, is principle number 1. And it is absolutely, arguably, the most important principle of all. And here, let me get my drawing tool here. So here's what we're looking at. We'll use blue, about that size. So when a stock is moving up, 70–90% of the stocks are moving up with it. Now I know there are those cases where something like Apple could carry the market up for a short period of time. By itself, it can't carry the market for a length of time, but for short period of times, Apple, the Googles in the world, things like that, they could carry the market up for a little bit while most everything is trending down. What I have found is nice solid trends up where you get 70, 90% of the stocks actually moving up, that's where you make your best long trades. I don't think anybody would argue that with me. I really don't. Here's where I get the argument though. When stocks are moving down, I think the same thing. I think 70, 90% of the stocks moving, when the trend is down, 70, 90% of stocks are pushing it down. Then please answer me this. Why do people insist on being long? Why do you absolutely insist in being long? The same argument can be made if you've got 70, 90% of the stocks moving up and the trend is marching up, and a good trend, something you can say, hey, look at that thing trend. Why do people insist on shorting? There's no question about it. They're in a bullish trend. There are stocks going down. But why? I'm gonna take the big number here, okay? So if 90% of the stocks are moving up, why would you want to bet that you, because you're special, right, gonna pick that one stock or the one out of that 10%? Why would we want to do that? It makes no sense at all. Other than we're human. We love to gamble. Look at Vegas. Why do you think Vegas is so colorful, so beautiful, so exciting? Because people like to gamble. So why gamble though? Why gamble with your hard-earned money? If you want to gamble in Vegas, go ahead. You know, you set aside certain amount of money. Hey, I'm going to blow this, right? You know, okay, fine. But we're talking about life here. We're not talking about a weekend. We're talking about life. Go where the power is. So if you're going to be bullish, wait until there's a bullish trend. And now trade bullish instead of trying to be a bottom picker down here. Anyway, principle number one, I think, is the most important principle of all. Number two is right up there. Why in the world? Why here? Here we go. A chart is clearly trending down. Why does everybody try to pick the bottom? You know, if we're over here and we're trending down, and there's a say here, let's give this a we'll make it blue here, a doji, okay, and then a bullish engulf. Why do people insist on buying that bullish engulf? Because here's what happens 95% of the time. Where are we here? There we go. Buy the bullish engulf and it pops up and then it pulls back. People buying this, they don't close it out because really not a lot of money is being made. Not yet anyway, not to excite them. It pulls back and now they close it because, oh, doggone it, stock's no good. It didn't go anywhere. Just to find a few days later, it goes up. Now, look what we do. If you connect those lows with that low, you have a trend. Why not wait till the trend? Wait for your chart to be trading in the direction before you buy it. Now, this is true with shorts too, okay? So if we're moving up long, don't short until the trend starts. All this top catching and bottom catching. Here's what I tell people in the trading room. No kidding, I truly tell them this. You pick the bottom, send me your address really quick, and I'm going to go on my Amazon account and I'm going to order you a box of gloves and have them delivered to your house, because bottom picking is just seriously uncool. It does not work as a steady diet for 100% of the traders that I have ever met in my 34 years of trading. Now, if somebody here, please, I mean, don't be bashful. If you make a 100% steady diet of picking bottoms and you make money, let us know. Let us know. Why can't I get my, there we are. All right, plan your trades with targets. Look, here's the thing. For this 30 days, I will do this. I could do this hundreds of times. I mean, if you're in the room and you say, hey, can you plan a trade for this particular stock, long or short? I will literally do this 100 times. And I will guarantee you, I will do it less than 1 minute. It is that easy. It is that simple. It is not complicated. It is not rocket science. You know, the problem with trading is not Wall Street. Okay, it's not Wall Street. It's not, no one's looking over your shoulder, you know, and saying, hey, I just saw this person buy this. We're gonna, and they put their stop right down here at $10. Let's just run it down there, get their stop and go back up. Nobody's doing that. Okay, own it. Take some ownership. Take some ownership. Don't complicate it. Keep trading simple. I guarantee you that I can show you in that 30 days how to do a trade plan in less than 1 minute, and you will be completely comfortable with it. Completely comfortable with it, okay? So principle number 3, plan your trade with target areas and protective stops. Most people, when we start using words like plan your trade, we lose them. The eyes shut, the ears shut, the mind goes blank, because nobody wants to worry about a plan. Nobody wants a plan. I just want the chart that goes up. I want the chart that makes me money. That is all. Well, I do too. I'm with you. Unfortunately, I learned the hard way that you've got to have some kind of plan. And I believe I've got it down to 1 minute or less, and it is super easy to do. So please check it out, okay? Yeah. If anything, that would be something worthwhile learning right there. Wait for the setup. Okay, between myself and Doug Campbell, Right Way Options, and Ed Carter, 3 people very involved with our whole group here, and myself, me being third guy, we've come up with what we think is probably, I truly do believe this, is the best entry ever. I absolutely believe that. I'm convinced of it. Hundreds of other traders are convinced of it, so I can't be all full of poo or anything. It's amazing. It really is amazing. And this is something we will cover. Now, I have 3 favorite entry setups. They are very similar to each other, somewhat. So one entry is what we call the 3/8 trap. And that's simply using a fast moving average. I probably shouldn't have done it that way. Probably should have done it this way. A fast moving average, and then maybe a slower moving average. And now we're going to look for that, say a chart. It does this, maybe pulls back. It gives us a buy signal. That's something I'm going to look for. And we call that a 3/8 trap. One of my other favorite setups is below the highest high in the past 5 days. Very similar to the 3/8 trap. And many times that can be a 3/8 trap. But sometimes it'll bust out of the 3/8 trap but still be below the highest high in 5 days. I love that setup. The other one is the breakout. So I want to see that. And I can absolutely, hands down, make you comfortable with that, help you be comfortable with that if you're interested in such a thing. Now, I drew this bullishly. There is the same thing bearishly. Okay, so I'm not pushing anything bullish here. I will admit sometimes it's easier for me to talk about bullish, but it all works for the bearish side, and I think nowadays, for the time being, and maybe for a little bit of the future, for a while, we probably should be in tune with those bearish setups. So a great, easy, simple, extremely visual, and scannable. This is important. A scannable setup for an entry here, okay? Principle number 5. Yeah, I think we're doing pretty good. Principle number 5 here, take profits. Oh my gosh, take profits. I don't know why we sometimes think we have to make 100% on a trade. I don't know why our greed overcomes common sense or logic. I really don't know why. But it does. And again, we're human. It happens, and it happens to everybody, okay? It absolutely happens to everybody. Uh, so maybe what we need to think about is take profits into strength. One of the slides coming up is goals. I'll talk more about this on that slide there. Uh, but man, I'll tell you, uh, if you can make 15 to 25% in say 3 to 10 days, I'm a swing trader, short-term swing trader, so we could change that 3 to 1, so overnight to 10 days. You can change it to 15 days, but on an average, if you could make 10 to 25% of your money in 3 to 10 days, doesn't matter whether you're bullish or bearish, what would that do for your account? Just think about that. Um, baseball. Baseball games are not won with the home runs. They're won with the base hits. And that's what this is. Look for those base hits. We call them goals. And it's important to set goals. Again, I'll talk about that a little bit more on another slide, okay? I've seen this so many times where myself, okay, I'm believe me, I've done this many a time, where I've been in a trade and it's been up and it start to pull back and I don't take profits and it hits a target. We work with targets and price action and where charts may go. So we work with that and you hit a target. But if the chart looks like this, if you got a day, another day, man, I've been there. You don't take profits. It's going to the moon. The market is in great shape. It's running high. It's going. Again, we're only talking right here about bullish, but it could be. We get to be saying the same thing about the bearish side of things. Okay, and here we start moving up. Why would I want to sell this? Why? It looks like it's going to go higher. And you wake up the next morning, and what happens? It drops. And you think, hey, that's okay. That's all right, because it's hanging on to itself right here, right? And then it goes down. Uh-oh, now we're getting close. Well, shoot, now we're about to get back to a double bottom here, so I think I'll just hang on to it. Well, now you've made no money, and here's the worst thing of all, it actually goes lower when you had a 15 to 25% profit maybe. What in the world? Now, here's the worst thing. If these were all days, if it all happened with these days right here, 1, 2, 3, 4, 5, 6, 7, 8 days, you can never get that back. They're gone. Those days are gone. There's about 210 days in a year to trade. That, you take away some vacation time, sick time, natural market holidays. There's about 210 days. Can you waste 8 days? I can't. So why throw good money away? Why? Because we think we're going to make 100%. Yeah. Another thing, I don't know why traders seem to think that they maybe have a job or they had a job. I don't know why new traders seem to think, or struggling traders maybe are in this, but definitely new traders. They seem to think that because they have a computer with a couple monitors and an account, that they should make 3, 4, 5 times the amount of money that they made at their job. Now, I'm not saying you don't deserve it, you do. But I don't know why people out of the gate seem to think that that's going to happen. It doesn't, okay? I'm sorry. It's just not going to happen. Principle number 6, setting goals. Yeah, let's talk about those goals. Okay, let's just get right down here, all right? Just show me the setup that makes money, right? It doesn't work that way. What would you think if you could double your account every 12 months? I mean, what would you think about that? So you have a $5,000 account. What if I told you you could double that in 12 months to $10,000? Now, right off the bat, you would think, well, that might be pretty cool. But you know what some other people are going to think? Well, shoot, that's not enough money. That's not enough money. Because $5,000. Look, I don't mean to be rude to anybody. I don't mean to, I'm not meaning to be mean or anything, but in the trading world, $5,000 is not a lot of money, and neither is $10,000. But you have to start somewhere. And if you could double your money in 12 months, and if I can show you how to do that, and then the next 12 months, if you could double your money, and then the next 12 months, you could double your money. Now we're starting to think right here, okay? But unfortunately, we're human. If you could see me right now, I could be holding up something and you would take your eyes off of me talking onto something that I'm holding up shaking, because we are very short-term in nature. We're humans. It is the way it is. But if you stick to your guns, 1, 2, well, actually 1, 2, 3 years, what would you think about that? Doubling your money, double 40,000 to 80,000. It is possible. I've done this. This is my goal. This is my goal every 12 months. Now, I'm not gonna lie to you. Do I get it? We break it down by, the year, the month, the week, the day. Not every day do I win. Not every week do I win. And there are times where every month I don't win. But at the end of the year, I can come pretty close to that, if not make it. And I've made it many, many years. So just think about it. What if you didn't make it? What if you didn't double your money? What if you were 10% short? I mean, are you going to quit? Are you going to jump off a bridge or something? No, you're not. So goals, just like a mechanic, a construction worker, plumber, doctor, architect, tools, the right tools are critical, very, very critical. While everybody just wants to see a chart, show me the setup, give me the scan, tell me the chart that's going to work. That's not the way it works. That's not the way it works. And then when you fail, you end up blaming everybody but yourself. We're human. Ladies and gentlemen, I've done this for too long. I have been where you might be. I have failed and lost money in trading. In the beginning, yes, absolutely. A lot of it. Setting goals is very critical. It's an essential tool to have while you're trading. Okay. Principle number 6. Principle number 7, know when you're over your head. Maybe I should make this principle number 1, to tell you the truth. Know when you're over your head. One of the things that I like to talk about is if you are on a daily basis, your overall account, not one trade, not a single trade, but your overall account. If you are underwater 2 days in a row or 3 days in a row, if your account, say it starts here and at the end of one day, it's okay if it's down. I mean, that happens. If it's down 2 days, start to question it. If it's down 3 days, stop what the heck you're doing. Don't hope. Stop. The number one killer for a trading account is losses. It's not your wins. The number one rule in trading is not making money. Hate to tell you that. That's not the number one rule. You know what the number 2 rule is? I can tell you what it's not. It's not making money. It's not. The first 10 rules of trading is not making money. Don't worry about it. All top 10 rules in trading is do not lose your money. That's what the top 10 rule, 1 through 10 rules are right there. Do not lose your money. But what happens here is you're holding on to a position. Somebody told you it was going to bounce or something. Look, you're the boss. Somewhere I've got a slide in that. Own what you do. Take control. Stop the bleeding. It will kill you. This is a good place for me to talk about pooping like an elephant and eating like a bird. Here's what'll happen. You'll take losses that look like that, but you'll take gains that look like that. That is pooping like a bird, and I'm sorry, pooping like an elephant, and that is eating like a bird. Your account will only last so long. Now, if you continue to do this, stop, evaluate. What are you doing wrong? Could it be, I thought I wrote this in here somewhere. Could it be, yeah, I did write it somewhere. What is that? Knowing you're over your head, stay in your lane. Could it be that earnings, for instance, earnings is a taboo for me. Now, usually during earnings season, I'll trade one, maybe two trades that are about to go into earnings. But other than that, earnings is a taboo. Don't trade earnings. Here's the only people that I think should trade earnings, okay? If you have an account that has that many zeros behind it, you can trade all the earnings you want because you can probably afford it. But if you have a $5,000 account, you can't afford trade earnings. You can't do it. Two reasons. One, if you have a $5,000 account, it's too small. And number two, if you have a $5,000 account, you probably haven't been trading enough to know how to trade earnings or what to expect on earnings. So the only people that really should be trading earnings is somebody that has an account with that many zeros, because earnings will bite you. You might be over your head. Stay in your lane. If you're trading, if you're losing money all the time through earnings, then stop doing it. No kidding. My wife, we had some grandbabies over this past weekend. My wife said, man, it really hurts my back when I hold the grandbabies. I just laughed, said, no worries, stop holding them, I will. It's pretty simple. That's not going to happen, but in trading it can be. Just stop. Fed days like today. Are you over your head trading? You know, we're in your account. Look, and I know there's people that made money. Okay, I get it. I absolutely get it. I know there's people that made money. But if you didn't make money, and this constantly happens, and you're you know, one of those people that cusses the feds or that says damn government, you know, oh, I wish they would do this or I wish they would do that. Stop blaming them. Just stop blaming them. Own it. You're the boss, man. It's your money. Why trade through those days? You know, you get this crazy chop, 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 chop. You know, right here, maybe you're going long or short, expecting something, and it goes the other way and you lose a buck. And you keep doing it and keep doing it and keep doing it. Stay in your lane. So you know what staying in your lane might be? Something like this. If you want to be bullish, not a problem. Not a problem at all. What did I just do here? Just did something wrong. Arrow green. There we go. Wait for a trend and trade the trend. If you want to be bearish, no problem. Whoops. Did that wrong, didn't I? Trade the trend. Don't trade chop. Stay in your lane. If you have to sit out of the market for a couple of days, wouldn't it be worth it not to lose all your money? So many accounts I've seen do this right here. Your account, this is your account. Your account grows. These are weeks. Let's make these represent weeks right here. Okay, they move up. All of a sudden, there's earnings maybe or Fed days maybe, and then what happens? Something changes. The attitude of the market changes, but you keep doing this same old thing, which has been working great, by the way, here. Okay, but you don't shift or change with the market. How many people have lost everything, 3/4 of everything, in 1 week that took you 1, 2, 3, 4, 5 weeks to make, or maybe 1 day? Know when to trade, know when not to trade. Know when the market is your market, know when the market is not your market. It's okay to be in cash. It's all right, okay? The risk's simply too high. Principle number 9, this is the last one, and then we're going to go look at some charts, and I'm doing okay on time. Thank you for everybody that's here. I do appreciate it, okay, for hanging around. This one right here is probably the best education you will ever get. I'll get to that in 1 second. But first of all, when you place a trade and you share it with people, whether it be in a trading room, your neighbor, your spouse, friends, family, just share what you're doing. Don't be ashamed of what you're doing. Share it. You will help somebody else because somebody will see what you're doing. You know, if you're trading a chart that, I don't know, you know, does this and you're buying it right here, somebody will look at that and they might learn something. They might say, hey, I didn't notice that. Or maybe you trade stochastics perhaps, and stochastics is in an oversold position and starting to turn up. Or maybe MACD crossing the center line, something like that. Share what you do. Bollinger Bands, if that's what you know, if that's your thing, you know, share. You are helping somebody else. Pay it forward. I first said that this could be the best education you ever get. I'm not going to tell the story here. I'll tell the story in the room for the 100th time or more tomorrow, or if you guys ask, I'll tell you the story about what made me a better trader. And it was this thing right here. This, what I'm about to say, is when you share, you become a better trader. Because if you don't share, if you're just sitting there and knowing everything you know, you buy a trade, you're not accountable to anybody. You're not accountable, and yourself is not accountable. You can't be accountable to yourself. It doesn't work that way. Doesn't work that way at all. You'll move stops. You'll fudge on an entry. You'll fudge on an exit. You know, you can't be accountable to yourself. Be accountable to somebody else. So when you put a trade out there, say in a trading room, to your friends, to your neighbors, you know what? Somebody just might ask you a few days later, hey, how'd that trade work out? Oh, crap. Yeah, be accountable. It will make you a better trader. You will think about that trade before you push that button. You'll make sure that that market is trending in your direction. You'll make sure that that chart that you're trading is trending in the direction you want it to go. You'll make sure that you've got your trade plan set up, your stops set up. You'll make sure that you're taking profits into strength or weakness if it's a short. You'll make sure that you're living up to your goal so you can double your money. Pay it forward. It's a win-win, believe me, it really is. So I don't know, I probably should have changed this. Again, if somebody came in late, my name is Rick Sadler, founder of Hit Run Candlesticks. I hope these 9 principles help, okay? I know all we want to do is see charts. I understand that. And we're going to get to that. And I still have time left here. And I'm going to look at your charts. You ask me questions, we'll look at those charts. I'll show you exactly what I do in the trading room. I'll show you exactly how I might send an alert to you. I'll absolutely show you that, okay? That's about it. I don't know, oh, there. Sherry, I don't know if you have the link. I posted it there earlier. I don't know.
Okay, you want me to share it now?
Yeah, you could share it now.
All right, cool.
But with that said,
Did you see what Michael Turpin said?
no, I didn't. Where? Let's see. How do I get to my questions? If there's any questions. What did Michael Turpin say?
Hey, Rick, I heard you like a nice rounded bottom. Is that true?
Oh, Sherry, you're making me blush. That is true. Yes, 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 I do. So let's talk about that while we're here. Okay. Everyone should see my chart. This is TC 2000. And I
All
do
right, I'm
have
gonna
some
share your
time
link
left
now. Yeah.
here. So we'll do that. And we'll look, let me see if I can find a rounded bottom breakout. Let's see, ACAD, what is that? Okay, this is a rounded bottom breakout right here. A rounded bottom breakout, by the way, is I've probably made more money on this setup than anything, any type of trade setup at all. I've made more money on this, and you know, I'm limited to time here, folks. So please join us in the trading room if you can. I will be making videos on these for you if you can't be in the trading room. But bottom line, right here is the beginning of the rounded bottom breakout, right in here. And look at the money that could have been made. And we're swing traders. And by the way, that would not have necessarily been the buy. It could have been. Right there would have been a good buy. And look at your swing right in there. Perfect. There is no buy signal here. All of a sudden, there's one. Look at your swing right there. There is no real buy signal here. I take that back. There actually is some candlestick buy signals, but this line right here, that we call that the dotted deuce, it's basically the 200 period moving average with some twists and turns on it. I'll be more than happy to explain that in the room. We're just lacking time right now. I would have to wait till this trade moved successfully over that line, and you can see today it's not doing that. But this trade right here, this is a rounded bottom breakout. Absolutely terrific. So let's see here. So does anyone have any one chart you want to take a look at? Or any questions? And I can't, maybe there's no questions too. I don't know. Let's see, I'm looking for them here. Yeah, I still don't see anything.
Oh, yeah, there's some there for you.
Yeah, I
Usually
can't
what you
see
gotta do
them.
is break out the questions box. It's on the questions, not the chat. So if
Okay,
you pop out the questions, and then what I do is I sort it so that the most recent one is at the top.
Oh, look at that. Whole bunch of them. Okay. Wait a minute here.
And Dan Chu especially said, what is the win rate for the 3 setups from when you had your 3 favorite setups up on the screen?
Uh-huh. Okay.
You know what
Great.
your actual, you know.
Great question. Look, let's break the market down into 3 pieces, okay? You've got a trending market, a bullish trending market. You've got a bearish trending market. And then you have a market that's just junk, just absolute junk, okay? When everything is right, when the trend is up, the market just closed, okay. Right here. When the trend, let me get rid of this. There we are. When the trend is up and you're working within the trend, all right? So the trend is up, we're working within the trend. And every trader, the way the question, let me explain this. The way the question was asked was like an absolute. There are no absolutes in trading. None. Zero. The only, here's one, an absolute in trading, your internet is going to go down one of these days and you're going to panic. That's an absolute in trading. That will happen. But as far as is it perfect? No. But if you put your trend in order, a bullish trend, a bearish trend, and if you trade that 3/8 trap setup or one of those 3 I showed you, which is very similar to a 3/8 trap setup, here I can put, there we go. That would be the 3 right there. So if we come in here and we traded this market, right? Let's do this. So by the way, this is a rounded bottom breakout right here. This whole setup right through here is a rounded bottom breakout. We're up. If we came in here and that would be your buy, or maybe that breakout. Look at the money that could have been made on that swing. No one says you have to close it because nothing has actually failed here in this particular case. If you did close it, there is another 3/8 trap. And then of course, right above it, probably make it a different color, huh? Right above it would have been the breakout. And look at the money you would have made there. Now, shorting is the exact same way. Now, my 3 here is not set up for shorts. I could set it up for shorts. There we go. Now it's set up for shorts. So put the market in your favor, meaning we're down. See those red dots right there? We're bearish. Green dots, we're bullish. Red dots, bearish. So here we are bearish. See how we move down right here? This is a 3/8 trap right in there. And this chart could have been bought, and I might still hold this even though we closed over the T line here. This would have been a 3/8 trap right through here, right through there. Here money's to be made. Maybe you pulled some profits off, 1, 2, 3, 4, 5, 6 candles down. I mean, how much money do you want to make? Please don't anybody tell me as much as possible. That is guaranteed you're going to fail in trading. Take the money, profit into weakness for a short. So we move back up, we come back down. There's a 3/8 trap right there. If and we have a scanner. You could definitely catch these. There's not a problem. So your win rate can be 60 to 75%, but it doesn't mean you as a human. It doesn't mean it's mechanically going to make you money. Nothing does that. Nothing. We as a trader, we've got to have that foundation down. We've got to have rules in place. We have to set up a trade. We're human. So it's not going to win every single time. But if the rules are followed, you could win 75% of the time. I think more than that would be kind of a stretch. But number 1 rule, make sure the market is in your favor if you're long. Make sure it's in your favor if it's short. Never trade through chop. If you think it's going to work through chop, smoking dope. It's not. Nothing works through chop. Chop is what Wall Street wants retail traders to do because that's where Wall Street makes good money. So next question. See, I really don't know where we are. Let's see, I'm going to start from the bottom. That just makes sense more to me, and then I'll work up. It's because it's what I can see, and I know where to start.
Yeah.
Okay.
Yeah.
Let's see, what time frame best results? I personally think daily. Daily, Stephanie. But then again, that's up to the trader. Okay. I'm a daily swing trader. The same, say, entry setup works on any time frame. I think intraday time frames is for the devil. I think it's horrible. I think most traders lose money when they work inside anything less than a daily chart. I do love a 130-minute chart. We call that a 3-bar chart. But overall, I do work from the daily. It doesn't mean it's where you should work from. It's just where I work from. Hello, DVN. Okay, let's take a look at that. DVN. All right. I'm going to get rid of this because I don't usually have that on my screen. There we are. So I'm looking at DVN here. I only see a short. That's all. So I'll do this one time really quick. Let's set this up for short, and let me explain why. I see a short, but I want to add a little caveat in there, okay? We have a trend. We clearly have a trend to the downside. You can put your lines wherever you want. This is kind of what I do. I'm a little sloppy about that. I can explain more of that in the training room. I see a downtrend right here. I see an uptrend, and I'm going to use the 50 period moving average. For those that don't know, I'm very big on moving averages. Very, very big on that. So I see a bullish trend here. I see a bearish trend here. So what are we going to do? How about absolutely nothing? Do not risk your money. Number one rule is do not risk money. This is a risk in here. What if we wanted to trade this long? Okay, let's trade it long. Let's wait for a breakout. Let it set up for that 3/8 track, that pullback lower than the higher high in the past 5 days, something like that. This is exactly what I'm going to look for. And we're going to look for a bullish candle. And we will have broken out over that trend. There is absolutely no earthly reason, zero reason to have to chase a stock at the bottom. Again, send me your address. I'll get on my Amazon account. I'll send you a box of gloves when you're picking your bottom. It just makes no sense. Now, what let's do here is set this up for long. And by the way, I just talked about long. But for the short side, let it, probably should use red, huh? Let it break down. Let it break down. You can short from that breakdown or let it rise and then short from the rise. But let it break out of that wedge right there. This right here, that's risky business. That is risky business. Okay, I'm going to set this up really quick. We can't do this. I don't know how much time I have. I can see by the clock I have at least 9 minutes here. So, but I'll set this up and we'll do it both ways. So I see a target right here, right there. I see a target about right here. And then we're going to go right to the right about here. Okay. Now we're not going to buy it till it's up here. So let's put, and I'm guessing on the buy because I have no idea where it's going to actually set up, but I'm going to put a line right there. And this is going to be, we want to buy above that line. So this is how I would set this up. Okay, there you go. So right from the get-go, we've got about a 13% trade from this bottom to this top. Now I'm going to put a buy box in here. I like putting the buy box in there, just like this. And let's paint it kind of red. This is what I do. This is what I'll teach you right there. Boom. Now, how are we going to trade this? We're going to put this on a watch list. I'm going to show you this really cool scanner. You don't have to have it. I send out alerts on our app, and I'll do a trade video on this if I was to buy this. So here's what I want to see. Just get yourself on up here. You know, show me you've got some bull action going on. Move up, pull back, because they always do every time. Let it set up, and then I'm going to wait for that candle to get me in. And now I'm not going to get 13%. I know that. I'm not going to get in at the very bottom. It would be a stroke of luck. And honestly, I just don't see me doing that. But I'll take 10% on that trade in a heartbeat. And I would trade an option on this, directional option, call option. So if you're looking at, 13%, if you trade options, you know that that's going to be a 25, 30% trade. So now let's set this up to the downside. So let's look at short targets. Maybe about, we better, I'm going to have to go right here. This is the dotted deuce. I don't know if you guys can see it very well. I keep them pretty dimmed down. That's the dotted deuce, that a 200 family. And this is the 200 period moving average right here. So I'm just going to split the middle for a target. And now let's come over here. Oh, I see a target right here. And then let's just go down to this low. And let's just, well, I guess we actually could go down here, couldn't we? Let's call that good. So what are we going to do? We're going to, again, we don't know exactly where we're going to buy it, right? We don't know. Nobody can guess that right now. So let's say we come down, we hit the, let's say we get down into this area and then we start to bounce right there. I know right where. Let's just do it below the 50 period moving average. So now what are we gonna do? We're gonna come up here, just like this, do something like that. Well, there's a 26% trade to the downside. And let's do this. Let's put our buy box in there. Let's paint that red. It's just because red shows up. Red has no value other than it shows up. There you go. So what am I going to look for the short side? I'm going to look for it to move down, bounce up into here because everything bounces up. And then what? Let's short this and then make some money to the downside, just like we can buy it to the upside. But buying it in here, why? I got a bat phone that it's going to go higher? I don't. Sorry, put it that way. But Stephanie, I just, we want to wait for the bulls if you want to be bullish. We want to wait for the sellers if we want to be bearish. Okay. I hope that helped. And thank you, Stephanie. I appreciate it. Okay. Thanks. Let's see. Hi, Rick. I heard you like yes. Like nice round of applause. Let's see. We answered that one. Please link. Okay. Yeah, we can do the link. Sherry will take care of that. Let's see. When can you tell a trend is in a place so you can buy? That's easy, okay? First of all, establish, and by the way, a trend is, I know everyone has heard the term, the trend is your friend, right? But nobody ever tells you what the trend is. Now, I'm gonna look at Netflix here, okay? I'm gonna get rid of all this. We can look at Netflix and we can say, we can draw lines. Now, honestly, I'm lazy, okay? I don't draw a ton of lines. I do draw lines. It's just not my go-to. The moving averages, however, my go-to. An example, what's wrong with that trend line right there? I don't think there's anything wrong with it. But if you want to draw a trend line, we can draw a trend line. There it is. So would we say that this is in a trend? I would absolutely say that. Do I think this is buyable right here? No, I don't, because it's not set up. So here's a good way to look and see if you're in a trend. I'm going to go over to this chart right here, and we're going to delete. Oh, there we go. And we're going to delete this right here. And we're going to delete this. And we're actually going to put up another moving average. We're going to change that to high. There we go. And let's turn that on. There we go. Number one, I think price action in candlesticks is the best thing since sliced bread. I truly do. Price action, you could spend months, years learning about price action. But if you just wake up on a Monday and you go to trading Tuesday, you don't have a clue what price action is, and you're going to lose money. Study price action. It will be so helpful to you. With that said, get rid of price action. If you want to start with, I only want to trade a trend, only trade the trend. And this is what I have determined to be the best trend for me, okay? It doesn't mean it's the best trend for you. So let me stop for a second. Trading, what you want to do is, trading is big, isn't it? I mean, there are so many indicators. There's so many things out there that it's huge. You go to read a book, you open up a charting program, and there's indicators crazy everywhere. What do I do? Well, first of all, you've got to know what you want. And if you don't know what you want, that's where you try to find some help, okay? Try to find some help. Come into the trading room, we'll talk about it. And what you want to do now is you want to take this big picture trading and you want to start drilling it down to exactly what you want. Exactly what you want. And that is the only thing that you're going to trade. You don't care about what I do. You don't care what David does. You don't care what Mr. Kramer does. You don't care what Mr. Buffett does. It's got nothing to do with your trading. You do what you do. But if you don't know what you want, it will never work. So you have to know what you want. With that said, this is what I want. Doesn't mean it's right for you, but it is right for me. The red dots and the red dots and the green dots, this is what we call the trendicator. When I have green dots, I basically am bullish. When the white line is above the green dots, I am bullish. When the yellow line is above the white line and the white line's above the green line, I am very bullish. On the other side of that, when it's flipped over, I am very bearish. Now, within that, let's stop right there. Let's stop right there. So let's look at Netflix. Am I bullish on Netflix? Yes, I'm extremely bullish on Netflix. Is it buyable right now? I don't know because I haven't looked at a chart with price action on it yet. But as far as the chart goes, I am very bullish. This was principle number 2, by the way. Let's look at principle number 1 first. Are we bullish and bearish on the market? Everybody must say, based on this chart, that you're bearish. So you are not bullish on the market. So what does that mean? That means no matter what, you cannot trade Netflix long. You cannot. Principle number 1, trade in the direction of the market. Put the wind at your back. This is where the market was bullish. This is where the market was bullish. This is where the market was bearish. This is where the market is bearish. So first of all, we can't trade Netflix. But with that said, let's go look at Netflix. Okay, back to Netflix. We can clearly see there's a trend. Now let's go look at price action. Do I see price action here that would make me want to be long? No, not at all. Where would I want to be long on here? Well, there are 2 places. One is if it pulls back all the way back into maybe this area right here. And by the way, up until about the last year or so, you hardly ever hear me talk about the 50-period moving average. It doesn't impress me. It is one of the most popular moving averages of so-called Wall Street, okay? I get that. Same with the 200-period moving average. But overall, I'm not overly impressed with the 50-period moving average. It doesn't usually fit my world. But because recently, the market has been an in and out or above and below the 50-period moving average like crazy, we have to pay attention to it. So I have become sort of a 50-period moving average person. So I would look for a buy if it pulls back and gave me a buy signal. What is a buy signal? I'm going to look for a candlestick signal. And the trend is up, isn't it? I mean, you can draw a trend line however you want this, but I'm going to be within that trend line. So that is working. That's one place I will buy it. Consider buying it. But the market is not going. Principle number 1, let's not forget about that. Now, where's the second place that I would consider buying? Is on a breakout. So I could do this. I could see possibly if above right there. You know what? I could do that better, can't I? There we go. There we go. So I'm not interested in buying this at the very bottom. You're never ever going to see me be a bottom picker. I do not want gloves from Amazon coming to me. So if we came in here, we gap down, and here we gap down, and then all of a sudden we put in a bullish candle. I'm not going to chase that. That's bottom picking. I'm going to wait till we get just about over 236.84. I'll pay a little higher for it. Now I will buy that even though we're kind of up against resistance. I would do that. The second place that I would look at buying this is on that breakout above the dotted deuce. This is a rounded bottom breakout, by the way. The dotted deuce is extremely important to the rounded bottom breakout. In fact, the dotted deuce was originally created for the rounded bottom breakout. So I have to see how we came right up to it and stopped. Make that bigger. We stopped, we stopped, we stopped. That's why that was created for that. So I'm going to wait for a breakout. And what am I going to do? I'm going to do this right here. The same thing that we've been talking about. I'm going to let it break out. I'm going to let it pull back into that 3/8 trap below the highest high in 5 days, something like that. We're going to look for a buy signal. If we don't catch it here, I'm not worried about catching it on a breakout. I might do that. Any way you look at it, let's take this and open it up to our first target. First target because we have a big old gap. And, you know, I take that back. That's not the first target. There's a couple targets in between on Netflix. But we're looking at 30% from here to the 200. I'm sure we can make some money in that. If rule number one, or principle number one, started working, and if principle number two started working, which is principle number two is trade in the direction of the market, which actually it's working now. We just don't have the buy signal in there right now. I hope that was a long chat getting to that. I hope it helped. I truly hope it helped. Okay, let's see. Is there a replay link? Yeah, Sherry, you'll get that. I think that's it. All right. I think, can you tell us? I think that's all. Is that right, Sherry? Or
Well, I mean, is that all for you?
no, I can stay here. If you'll have me, I'll stay here. I've got nothing to do today. Have dinner, maybe.
Oh, I did put up your link, so
Thank you.
maybe you want to pull that up and go over that with folks, and then we'll call it a day.
Okay, look, this is the landing page. It's nothing fancy here. We've put some values with everything. Here's 3 things that I want. Well, 2 things that I need you to do. Anybody here, if you become a trial member, number 1, you will receive an email scheduling 1-hour private coaching. I do this through Skype. It is one-on-one private coaching. So number 1, you get that. They go fast, so make sure you get signed up for that, okay? And you'll receive a calendar, and then you just pick the date that works for you. Number 2 is at the app. Get the app downloaded. Cheapers, get that, and you'll receive instructions on how to do that. And if you don't mind, I'd like to give a demonstration on the logic trade, and then I'll be done if that's okay, Sherry. But right in here, the logic video, this is something kind of new that we've just started doing. And I've heard back from, this might be hard for you to read. I've heard back from a lot of people that this is about the coolest thing they've ever heard of, is making this trade logic video. It's made after we've made the trade. It takes about 5 minutes maybe, and I'll run through an exact example, well, almost exact. I'm not going to go through the video rendering with you here, but I'll go through the minute of trade setup that I send you. I'll do that. And a lot of other stuff that you get here, just so worth it. I think it is. Anyway, we'll start doing these videos Wednesday of important subjects. And I'm doing the videos only in case you can't be in the trading room. I will send them to you. Everybody, all members will get the videos. I'm not going to pick you out personally. I don't even know if you're in the room or not. But we'll do that. Okay. All right. Give me a minute. Let me do a setup for a trade. Boy, everything is down, isn't it? Oh, you know what? Here's no, let's not do that. Well, I tell you what, let's do Amazon. Okay. Yeah, let's clear this off. Okay, so You gotta realize I've probably been looking at Amazon, so I've got a couple things already in my mind. So might go a little faster than what I'm doing right now, because right now it's all kind of from scratch here. So I'm gonna look at 114.90 as a target. We'll put something around 110, and well, let me finish this one thing at a time. Let's call that good, okay? So I'm going to look at this short. Why? Because of this. Principle number 1 is down. Principle number 2, Amazon is down. So let's look at this short. So what I'm going to do here is, now that I've got some targets in there, I'm going to put a stop in there. Boy, I'm not going to do that. Not in 100 years would I do that trade. I'm going to have to just do it today because it's down so much. You'll see what I mean here. So now let's take this, and this is exactly what I do. You know, there's no way. The only way I'm going to be able to take this trade is if it bounces up. I can tell you that right now. Okay. So let's paint this red. This is exactly what I do. All right. I set this up. Now I turn the recorder on. Well, yeah, I turn the recorder on, and here I go. Hey, this is Rick with Hit and Run Candlesticks. We just took a short on Amazon. I just posted on the app. I'm going to make stuff up here, okay? Because I don't have my platform up for trading. We just bought some Amazon puts, whatever strike price. You know, we're going to go out 40, 50 days, and then whatever strike price. All right. So I already sent that to you. I've already sent that to you. Now, what I'm going to do is, all right, right now I'm looking at 122.60 as a stop. There's just no way on earth I'm going to buy this unless it pops up. But if it, well, we've already bought it in make-believe, right? Okay, so make-believe. So our first target is going to be down here at 114.90, second target at 110.30, 105.90. In those areas, we'll look at those targets. If we bought it right here at whatever this price was, 118.66, we're looking at a 4.8% loss because that's our stop. And if we bought it at this top, we're looking at approximately 17% all the way down here. That would be the end of the video. I render the video. I send the video to you. Once I send it, you have it in a split second. Takes me about 5 minutes to do this, render it, and get it sent to you. That's the video logic, and it's called that. It would be called the Amazon trade logic video. So there we go. Sherry, thank you so very much for having me here. I appreciate it. Everybody that's still in the room listening, thank you. For those that were here, thank you very much. Sherry, I can't wait to do this again. Thank you so very much.
All right. Holding you to it. I always enjoy it when you can come. I know that our watchers and listeners also enjoy, because it's such a lesson, you know, so much good training going on. So guys, go over to that link. It's in the chat. You'll be able to sign up. Did you have a number on that Hit and Run on the 30-day trial? Is there a price?
Oh, $49.
Is it free? 49.
Nice,
So
49.
that's a killer value. So another no-brainer for the day. We have we've had 4 really awesome traders come with their expert trainings, and these are things that you really want to take advantage of. So I don't think I've ever worked in an industry where people who are experts are so willing to share their knowledge and to help people do better. And so I really appreciate you coming in here and helping us.
Thank you very much. Remember that one of those principles, pay it forward. It helps everybody. It's a win-win.
Yeah, definitely. All right. Well, thank you very, very much, Rick. And I hope you have a wonderful evening and dinner.
All right. Thank you, Sherry. Take care, okay? Thank you, everybody.
Thank you.
Bye-bye now.
Bye now. All right, folks, there we have it. Another great Traders exclusive event in the bag. You're going to have the opportunity to see the replay on tradersexclusive.com, and when you go to the site, you go to trading videos, we go to trader education, I believe it is. Nope. It's on the home page. Visit our trading education webinars, and then you'll see what we have coming up. We've got a few dates left for the year. Folks, if you know someone who is someone you like to learn from and hasn't been here on the event, please email me and I'll invite them, and we'll get more traders and more experts in to share their knowledge and their expertise. So then the next thing would be our Twitter is options_info, and tradersexclusive.com, of course. And for all of the speakers, I want to thank my speakers for showing up and for bringing us such great value. And for everyone who is here today, I really appreciate it. Let us know your big takeaway. Much appreciation to you for being here until now. And from me, Sherry, and all of us at Traders Exclusive, we want to tell and say, trade well, and we hope you'll join us in October for our next live event. Have a good day. Trade well.